to build up a firm capable of providing personalized, custom-made solutions to the clients. And I insist on personalized because you see, before that, I was part of EY here in France. I was the executive director in charge of transfer pricing for the Southeast area. So first in Paris, then in Lyon, and from Lyon, I used to navigate between Lyon and Marseille down south. And when I was at EY, I realized that the way the network was working was very complicated. I experienced a situation working for CMA CGM, you know, the client, Rubina, for which I had to supervise 50 other EY entities all around the world to deliver a common project. And it revealed to be very complicated. It's too big to handle, too expensive, too many processes, etc. And the reason I'm saying that is because when I left EY about 5 years ago to create Cara, I then joined PPI Network in 2019, indeed, and I found exactly the opposite. I found a network made of highly skilled professionals with the capacity to deliver custom-made, personalized, yet state-of-the-art solutions and services. And that works, clearly. I can witness that this clearly is working. We had synergies and common projects with Rubina a few months ago, some others with Pratik for another multi-billion French-based group, actually, encountering issues pertaining to France and the US. I also work with Harrison Gao, but yeah, he's not here today, unfortunately. And we've got regular interactions with, again, Rubina, Jimmy, Jose for the EMEA area. So yeah, it is clearly working, and I really take pride in being part of this network and you know, being among you today and for this conference that I wanted to say. For what pertains also to taxation, just a very quick update on the status of French international taxation or transfer pricing arena, very quickly, even though it's not a topic that we will explore in detail today, of course. But just so that you know already that France is an active member of the OECD, not only because the OECD is headquartered here in Paris, but as you know, also because the former head of the Center for Tax Policies and Administration is a French guy, Pascal Satamon. And he actively participated to the BEPS project, etc., etc. So yes, of course, France is an active member. Yet, it is quite impressive to see how rapidly the OECD guidelines clearly irrigated our own domestic taxation. After the BEPS, all the French reforms and measures were clearly a reflection of these OECD standards, even though, as you know, the OECD only makes soft law. So there is no direct implementation into our domestic tax arena. And it is quite strange because all those guidelines, they are inspired from common law or liberal type of mindsets. Whereas, as you know, while the French economic landscape clearly is not liberal, I mean, we saw it yesterday again, it's quite reluctant to adopting liberal and common law type of measures. So we enter into some kind of a weird world where we have international tax standards and regulations inspired by common law and liberal. And we have an economy which is quite the opposite, quite complicated to handle. Few examples in this regard, but the DEMPI functions, for example. As you know, historically, France has been a contract law type of country, so the exact opposite of a common law type of country. Still, the tax administration clearly admits that to recognize the legitimate ownership of an IP, they will refer to the DEMPI functions rather than the legal ownership of the IP, which is, again, completely awkward for the contract law type of country. Basically, everything that deals with contract law or what I would call written law tends to be put aside when it comes to international taxation. And we much more prefer applying the content over form, liberal or common law type of approaches. And the same goes with the ex post, ex ante approach, as you know it. To date, we still hold tight to the ex ante approach, not because it's in the code or in the law, but it's because there is a very ancient, it dates back to 1995. But still, in transfer pricing arena, that's the Stone Age, of course. But so we still refer to an old case law provided by the Court of Appeal, the Tax Court of Appeal, that holds tight to the ex ante approach. But for how long? I'm confident that in the coming few years, maybe couple of years, this will be reversed. And at some point, the tax administration and the tax court will say, okay, we need to adopt this ex post approach, which again is a very common law type of approach. Whereas even though you have formalized something in a decent and fair intercompany agreement, that's obviously worth nothing. Well, let's put it this way, because obviously you can like renegotiate or changes the terms, a few years after. So that's just something I wanted to tell, just for your information. I'm very confident and sure that next time we meet, eventually next year, I will have lots to say about this French taxation and the changes that will be implemented going forward, and that will clearly be inspired by OECD and certainly your jurisdiction's standards and regulations as well.
Thank you so much.
Yeah, my pleasure. Thank you all.
Don't worry. Don't worry. Thank you. It's okay. Thank you, Terence. Right now, we will have some words also from the person that made all of this possible. He's Adrian Romero, an economist, entrepreneur, and coach certified by the International Association of Coaching. Additionally, Adrian is an expert in transfer pricing and EOS implementation, a professor of businesses in private universities, and a speaker at international events. Adrian has been recognized as the game changer of the year by the ACQ5 Global Awards between 2016 and 2018. Chief Executive Officer of Pride Partners International, visionary and designer of these events, and all the activities are in PPI. Welcome, Adrian. You have the floor. Yes. There you go.
Thank you. Small room, so I don't think even the mic is necessary. Can you hear me? Yes. Perfect. Cool. I'll let this here. Well, I just want to say welcome, everyone. This is actually the first in-person event that we are able to put together. This was supposed to happen during the pandemic, and obviously it wasn't possible. So first of all, I want to thank our team, Ariadna, Luceli, the staff that we have back home for doing all of the event, making everything possible. Obviously, it was a lot of logistics, a lot of work, a lot of calls, emails. You probably had, 100 emails in your inbox from Ariadna. A lot of work, I know, for a small team. But even with that, we were able to pull it together. And this is the first official annual conference of Pride Partners International. As you might be aware, the group started no more than 5 years ago in paper. And then we were actively recruiting members, let's say 3 or 4 years ago. And right now we have 40 different members with offices present in 70 countries. We expect that by next year, we should be at least at 55 members. We already have some additional members in the pipeline going through the due diligence process. But next year's event should be at least between 70 and 80 attendees. So thank you for being part of the Pride Partners International history today. We have members from different places. I know for a lot of our European members, it was basically like it was comparable to a short bike drive. For others, like Luceli, it was an attempt of a bike drive. If you weren't here last night, you know that she had a small accident driving a bike. And we also have members flying all the way from America, Latin America. Marcio, I know you had some complexities and challenges that we provide. So thank you very much for making it possible. To our special guests, we have people from the CIAT in Latin America, which is the Inter-American Tax Authority Center. Is that correctly? Ariadna prepared a welcoming speech that I'm clearly not following. We also have members or special guests from the European Bank for Reconstruction and Development. Was that right? Okay, and we also have people from the OECD, I think coming this morning to present, and some special guests from multinational companies that are here to share with us their experience. Again, thank you all. I hope that this next couple of days are very valuable, not only in the technical aspect, because as we know, it's great to be here and share and be face to face. We have amazing panels in the next 2 days. We have good social events organized for tonight and tomorrow. I hope you can stay. But these events are eventually all about building relationships. It's not the same being through Zoom, talking through the screen, and I think a lot of us are tired from that. We're done with Zoom meetings, but this is a great opportunity to build, friendship, relationships. Last night we just had a couple of hours to share, how was the trip, how's family, how's the weather over there, small talk. But we already have a lot of good ideas of how to interact and, develop more business amongst our firms. I've been to these events a lot of times in many big, organizations with hundreds of people in the room. And it feels more like coming to a seminar because you're there, you're listening, you're taking notes, and then you're off to your house. The purpose of this event and always focusing on quality and having a smaller group is to really be able to build those relationships and get to know the capabilities of other members and explore ways to proactively work together. I think that based on our conversation last night, the word is to be proactive. Not only being proactive with our clients, but being proactive and accountable for our firm's growth, our firm's expansion. And that really starts with building quality relationships that we can really maximize throughout the year. So thank you for being here. Welcome. And I hope you enjoyed the event, and reach out to any of our staff members, including myself, if you need anything. So I think that's it, and let's get started.
Yeah.
Thank you.
Thank you so much. Right now, we will begin with the panels of discussion. The first panel of discussion will be the new profit split method guidelines. But before we start with this panel of discussion, I would like to talk to you about how it's going to be the methodology that we will use. So at the beginning, we will present each of the panelists. Then each of them will have 10 minutes to have a presentation of the topic that they will be discussing. And after that, you will have a little space of 25 minutes to make any comments or questions to any of the specialists that you will have in that panel of discussion. And later we will have also different workshops during this day and tomorrow, right? So to present you the new and the first panel of discussions, that is for the practical implications of the European planning regarding the new profit split method guidelines, I would like to present and let us be part of this panel of discussion to Jimmy van der Swan, partner at Taxan Netherlands. Jimmy specializes in the energy sector, covering aspects relating to taxation of oil and gas, supplier and contractors, electricity, alternative resources, and renewables. He advises on corporate tax issues and heads the Dutch transfer pricing practice, providing functional and economic analysis, profit allocation, and advanced pricing arrangements with the tax authorities. He also assists with domestic and international matters such as tax control frameworks, setting up and analyzing new businesses and joint ventures, and optimizing existing businesses structures. Jimmy, please come with us. Welcome. don't, wo- don't worry. Second, Jose Otero. He's a partner at Transfer Pricing Specialist Spain. Jose joined TPS in 2016 as a partner. Prior to joining TPS, Jose was an integral part of the transfer pricing department of KPMG US, KPMG Spain, and PwC. Jose Antonio practiced also for 4 years in Boston, Massachusetts, USA, allowing him to specialize in American transfer pricing practices. Throughout his 18 years of experience, Jose Antonio has collaborated in the design, planning, and implementation and documentation of transfer pricing policies for various multinational groups. He has also participated in the negotiation of several APAs, as well as advising Spanish companies in tax audit procedures related to the valuation and related party transactions. Welcome, Jose. Also, we will have Marco Gaspari, his partner at GL Tax. Marco is the founder of GL Tax. His practice focuses in advising the top management of industrial and commercial companies regarding tax and corporate law matters, as well as on reorganizations, mergers, and acquisitions at the national and international level. Marco is also specialized on advising multinational groups on transfer policies and assisting clients in the context of transfer pricing pre-litigation, settlement procedures, or tax litigation before the local tax courts. He also assists multinational groups with the drafting of appropriate transfer pricing documentation. Marco holds boards of directors and audit committee positions within Italian companies. Welcome, Marco. Also, we will have Anna Wislow, partner at CRIDO. Anna is being a partner of our CRIDO's transfer policy team. Her hands-on experience include 15 years of work on transfer pricing projects for domestic and international clients. Her portfolio encompasses a vast gamut of projects regarding, among other things, negotiation, advanced pricing agreements with the Ministry of Finance and preparation of transaction valuation for tax purposes. She also assists clients in the course of inspection held in by tax offices and the Tax Inspection Authority in the respect of transfer pricing, and design policies of transfer pricing, transaction flows, and settlement procedures. Anna has also been in charge of projects dealing with the determination of the arm's length prices of intragroup settlements, organizing international transfer pricing conferences, or conducting multiple lectures on transfer pricing. Thank you and welcome, Anna. And last but not least important, Peter Happ. Dr. Peter Happ studied for a Diplom Kaufmann degree in Business Administration at the University of Munster, subsequently acquiring his doctorate at the university's Institute of Auditing under the supervision of Professor Dr. Jörg Bacht. In 1998, Dr. Happ was granted the occupational title of, I'm really sorry for this name, Steuerberater, entitling him to provide advice on German taxes in a professional capacity. Dr. Happ attended classes in taxation and business law at the University of New York, where he also worked as a tax advisor and CPA assistant. In 2000, Peter Hebb was appointed certified public accountant by the state of New York. Dr. Hebb focuses on German and international corporate and partnership taxation. He also has an extensive experience in advising his net worth private individuals, healthcare professionals, hospitals, and institutions, as well as a charitable organization and domestic foreign trusts. Thank you and welcome. As you read now, we will start with our panel of discussion with our first panelist. Please, Jimmy, you have 10 minutes.
Can you hear me? Because I prefer to do it without a mic. If that's okay. Yeah.
I hear you.
I hear you. That was a question. Thanks. Can we show slides as well?
Yes.
Is that possible? I prepared a couple of slides on the profit split method and how it's being applied in the Netherlands. And to be honest, the profit split method is obviously not the most common methodology used in the Netherlands. The transactional net margin method, I think, counts for like 85 to 90% of the cases in the Netherlands. For interest rate, of course, that's most commonly the cap being applied. Although it's felt that, especially also due to COVID, the profit split method will be used more and more, and mainly due to the fact that key players within the business are scattered around the world because they do not simply do work from home. At the same time, we did have an interesting case already a couple of years ago, in which we did apply the profit split method. If we could move to the second slide.
Who's controlling the slides?
Yeah, not me for sure. Can we move to the next?
Yeah.
Oh,
Thank you. And now the disaster will become greater, I'm afraid. Okay. Well, I first deal with the case study, and from our view, the allocation key of the profit is key in the difficulty in applying the profit split method. So that will get some additional attention. Let's first deal with the. I hope that I would see the slide over there. That's the technique, I think. So this is the case that we dealt with, and it's good to keep in mind that this was a business which was highly regulated by governments from both the Netherlands, UK, and Germany, regulated in the energy market. And the regulators found it extremely important that all technology and IP created in the business was held by the companies together. And I think that's one of the reasons for being able to apply a profit split. So if you are doing a joint business, have joint efforts or joint risk or joint assets, that's at least the first threshold that you need to take for to be able to apply the profit split. And I make delivery of plans as a general term. It was not really a plan, but of course there's some we cannot disclose all facts and circumstances, of course, because we're not allowed to reveal these the names. And the company AB Company Limited and the German branch, the Dutch BV, and the UK company were really active in project engineering, and at all levels, research and development took place, either with the renewal to new plan concepts or to make the production process more efficient, and the production manufacturing was more taking place at the level of the German branch and the Netherlands. UK Limited was more involved in project management and engineering, and AB companies was more involved in contracting, sales, partnership, and conceptual design. So at all levels of the group, research and development took place, and all IP constantly remained owned by the companies together. The two companies in France and US were just installation companies, so they were remunerated on a cost plus or T&M market, if you like. The methodology that we applied is shown in this slide. So there was a profit split. Correct. Profit. Yeah. Right. No, I couldn't read anyway. The profit split was applied between the four in the yellow box equally. So just the remaining residual profit divided by 4. But before doing so, each of the companies did get a 7.5% markup on the total cost, including so employees, depreciation, etc. And the funny thing is that in this situation, we did not have a discussion with nor the German, nor the Dutch, nor the UK authority on why it was an equal split. The Germans took considerably longer than the Dutch authorities to agree on the setup. But I think that's at least it's my experience. But Peter, you can comment on that. The German authorities take generally a bit longer to decide on these processes. But all in all, we were keen on getting this multilateral ruling, which are still in place. I think which was not discussed was how to deal with the losses. In principle, obviously, the losses should also be split equally, but we did not discuss upfront how to deal with the T&M market in case of a loss situation. Would you then roll forward the 7.5% or not? I think all tax authorities accepted it, that it was not likely that there would be a loss generation. And of course, it's indicated in the OECD guidelines that you can apply a different split between profits on the one hand and losses on the other hand, but there's no further guidance on how you should support a different allocation of profits and losses. In our situation, we decided that profits and losses should be divided equally. Then allocation key determination. Now, I think that's the reason why profit split, at least for us, why we do not use it that often, because it's extremely difficult to demonstrate what would be the perfect allocation key. Should it be number of employees? Should it be asset use, turnover? Of course, I do realize it's always depending on the business model and the economics behind it. For example, if you are going to look at FTEs, are you going to rely on number of employees, or are you going to use salary costs? The salary costs, of course, can differ extreme between jurisdictions. It depends on whether you, for example, hire people in China or in Europe. So then the Netherlands or the Europe
They don't hear you on
they don't hear you. Oh wow! Please. This is better then. Then of course it's not immediately correct to say that for that purpose Europe should get a bigger part of the profit, and I think that's true for all the items on this slide. And an argument also heard in the Netherlands. Well, can we demonstrate any profit split is at arm's length, because it will be extremely hard or impossible to find third-party comparables. And since we can't, some authorities say, well, we do not apply the profit split, and we look at the routine functions, and that's of course also a thing which can be built into the profit split method by first allocation income to the routine functions like manufacturing or sales, and then just splitting the residual profit. That takes away a bit of the difficulties, but not fully, of course. It depends to be seen how quickly the application of the profit split will increase. And I know that colleagues of mine have been working with a RACI analysis. It's responsibility, accountability, and I always forget to see and informed consulted, and it's basically an additional layer built into the in the split method. I'm not sure, and if you use it yourself as well.
Use both RACI or RACI and the RACI. I will
Yeah.
explain it a bit in my case.
Yeah.
Because there are two analyses how to split the processes and the responsibilities within the processes
Yeah.
among particular entities
Yeah.
or particular individuals who are involved in the process.
Yeah, then I will only discuss it if it's already built into your case. I will just discuss it high level, because what's happening is that you first divide the business of the company in mega processes. Then as a second step, you divide these processes into smaller processes, and then you will allocate percentages of relevance to each part of the processes. And then you will have a RACI analysis, which is basically indicating how what the relevance of the involvement is of the people dealing with these processes, and then you set off against the relevance against the processes determined at the earlier steps, and then you come to a relevant. Then you come to an analysis which should be the profit split allocation. But for us, the reason not applying it too often in practice is that it's highly complicated and subjective, and that's a thing which we currently see happening with the Dutch tax authorities, at least, is that they reject almost every choice that you make in either a transfer pricing documentation or a benchmark, and they do not put forward an alternative, but just reject it, and that of course is contradictory to the law, because if they reject, they should provide a better alternative than what's being used in a benchmark. And the difficulty with this process is that there are even more choices to be made, so more chance to challenge, I would say. This is how it looks, because of course it's ultimately an Excel file that you are building, but it's extremely time consuming, because you need to interview many more people than you would normally, for example, do for preparing a local file or a master file. The outcome, on the other hand, can be extremely defendable, because it's really based on the internal information that you receive from the company, and that of course is the best argument towards the tax authorities that the analysis is economically, or at least at arm's length. So that's my brief introduction to the profit split.
Excellent. Thank you so much. Right now, we will have Marco Gaspari. He is online, and we already have his presentation. Yeah, he's going to put it there. Yeah, there it is.
No, this is mine.
That's NS. Yes, Marco, we can hear you.
I'm going to share my presentation.
Ah, thank you. Yeah, come. Yeah, don't worry. Marco, you have the floor.
First of all, I'm sorry that I wasn't able to join you in Paris. Hopefully, we will have a chance to meet again in person very, very soon. I know I don't have much time for my presentation, so I will try to be very brief. The main focus of my presentation is to provide you a general overview on the profit split method. We already heard from Jimmy an example of how it works. So I will probably repeat a few things that were already said, but I will try to be very, very fast. So first of all, a general overview. Profit split, as we all know, is one of the methods of transfer pricing that we use for determining arm's length prices. It's definitely a complex method, very difficult to apply most of the times. The main profit split aims to eliminate the effect on profits of special conditions made or reported in a control transaction by determining the division of profits that independent enterprises would have expected to achieve from engaging in the transaction under examination. Profit split is the main target of the profit split is to reflect the relative value of contribution of each enterprise involved, including the risk, the functions performed, the risk assumed, and the assets that are used for contribution. What are the strengths and the weaknesses of this method? Well, as for the strengths, we can certainly say that profit split is a valid solution in cases where the one-sided methods of plus, or let's say minus 10mm, are not appropriate. And they are not appropriate because each part of the transaction makes a unique and valuable contribution, which cannot be benchmarked with the one-sided method. So that's why you often switch to the profit split. Then another strength is that it can use the profit split where the level of integration or sharing of risk among the related parties involved in the transaction means that the contribution of each party cannot be evaluated in isolation. So when you cannot isolate, it's better to apply the profit split. And then, as a two-sided method, all the relevant parties to the transaction are directly evaluated, helping to ensure an arm's length result for each of the parties involved in the transaction. What are the weaknesses? Well, probably the weaknesses are more relevant than the strengths, unfortunately, for this method. Well, first of all, it might be difficult sometimes or often better to measure the relevant revenues and costs that have to be split between the parties. Profit split is also a method that is highly reliant on detailed data, and this data often comes from the multinational group, which is the group that we should evaluate on an arm's length basis. So this is probably a limitation of the profit split. Then sometimes determining the appropriate way to split the profits can be very challenging. And finally, profit split often relies on less direct information to determine the arm's length price. So this means that it's relatively rare to have access to reliable direct information, and this is a limitation. So when do we use the profit split? Well, certainly it cannot be regarded as a method of last resort. We should use it as most appropriate method to the circumstances of the case, but this is something that happens when also we decide to apply all the other methods. And it's often applied when we deal with intangible goods, for example, intellectual properties. Let's think about high technology pharmaceutical organizations when the transactions are so complex that the one-sided methods are really complicated to apply. So that's why we switched to the profit split method. We also apply profit split method. I can say this from my experience. For example, the pay-for-working business, which has nothing to do with intellectual properties, of course, but pay-for-working is one of those cases where profit split is probably the best method to be applied. But again, more in practical, when we use the profit split, well, first of all, as mentioned before, when each party to the transaction makes unique and valuable contribution. So that's one of the reasons why you should apply the profit split. Then when the business operations of the related parties are so highly integrated with each other that they cannot be evaluated in isolation. And further, when the parties share the assumption of economically significant risks or separately assume closely related risks. So in these cases, profit split is probably the best method to apply for determining an arm's length practice. The approach is, well, these lines that follow might have a very different declination, but let's stay with the general rules. So after determining the relevant profits, we have to split them on an economically valid basis. So how do you do that? Two are the main approaches, the contribution analysis approach and the residual analysis approach. Then there is sometimes in some jurisdictions the comparable profit split approach, but it is rarely applicable. The simple reason that you don't have comparables to apply the profit split. So you have to approach the profit split with the contribution analysis approach or the residual analysis approach. What are the main differences? So just an overview for all of you. Contribution analysis approach. The profits are allocated among the associated enterprises involved in the control transaction in a way where we should reflect a reasonable approximation of the divisions that would have been agreed by independent parties, of course, in similar circumstances. If available, but unfortunately are not often available, relevant external market data can be used to support this allocation. For example, if we have a comparable independent transaction between the taxpayer itself and an unrelated enterprise, this could be used to help us to divide, to split the profits in a valid economic way among the associated enterprises. In any case, when these external data are not available, which is in most of the cases, the arm's length principle can be applied by using data internal to the taxpayer themselves, which, as we said in one of the previous slides, to determine the relative value of each party's contribution. Of course, the fact that we don't have access to external market data represents a limitation to determine the arm's length with the profit split method. Then there is the residual analysis approach. This approach is appropriate to be applied when one or more parties in the control transaction make contributions that can be benchmarked. Usually contributions that are routine contributions. In this case, in step one, you usually apply a one-sided transfer pricing method to evaluate these contributions that can be benchmarked, and then in the second step, you have to you separate the profit that has been already allocated in step one with the benchmark, and then you allocate the residual profit on an economically valid basis. So basically, you apply in the second step with the residual profit the contribution analysis approach that was described in the previous slide. So just a brief summary of what are the strengths of the pros and cons of these two methods. Well, certainly we can say that probably the residual approach is more used in practice for two reasons. First of all, we break up a complicated transfer pricing problem into two manageable steps. And second, probably we potentially reduce conflicts with the tax authorities, because using the two-step approach, residual approach, we reduce the amount of profits that is split in the potentially more controversial second step. So that's why, at least based on my experience, I can say I apply more often the residual approach. Finally, I know I don't have much time. How can we split the profits? The profits, aggregated profits that have been generated, produced by all the parties involved in the control transaction and examination. It's important that the financial data of the entities need to be put on a common basis, including the accounting practice, currency used, and the reason is very simple. We are dealing with companies located in different jurisdictions. So in order to properly apply the profit split, we should adjust the accounting in order to have comparable data. Then the consistency over time is important. So if we adjust the accounting in order to have comparable data among associated enterprises, we have to be consistent over the time. And then when possible, and it's of course highly suggested, the profits, the financial data need to be properly segmented. So we should focus to apply the profit split only on that part of the P&L that is of course related to the control of the transaction. And finally, where a reliable product line for divisional accounts are available, this may be useful with determination of a relevant profit to be split. I'm not sure if we have anything else. I try to be very fast, and I think this is my presentation. So I leave the floor to the other speakers for the next speeches.
Thank you. Thank you so much, Marco. Excellent presentation. Now we will have Anna, that she is a partner of CRIDO.
Okay, thank you. Can we have my slide? Oh, thank you very much. Okay, guys, so I will present to you thank you. I will present to you a case study of a software development group that we recently have a challenge to advise in terms of the split of the profit. So my client is based, basically I cannot say that they are based in one country, because all of the entities that you have here on the slide are based in different countries, mostly European countries, but one of the entities was also in the US. So we had a business, we had a group that was developing software for mobile phones, basically apps, the different kinds of apps for applications for mobile phones. And they were, as you see, they were based in different countries, and different companies of this client have had their particular input into the business. So we had the main three companies, company A, B, and C, that were involved in basically the software development and design, the back office support, marketing, sales support, digital support. One of them was the IP owner, but in the terms of being legally owner of the IP. And the legal owner of the IP was also responsible for, or also had all the sales contracts with their clients. The owner also had the capital that was, financing all the businesses. They derived capital from also from the market. So they went to the stock exchange, and they were public. They were a public group. And also there were some minor companies involved in some support roles. but also one of the minor companies within the group had an M&A team, which at the end was important in this case. This is why I'm mentioning it. Okay, so this is the number of people each of the company employed. This is also very important because, as you may know, the tax authorities tend to allocate profits where there is most people when there is most people employed. Specifically, if the tax authorities want to use a cost plus or TNMM method. So, for example, in company B, you see that there's the vast majority of people employed within this group, whereas in company A, which is the IP owner that owns the sales contracts and has the capital to finance the group activities, there are only 10 people. Which is also very important in terms of the future case development. As you also see on the slide, all of the companies employ or have top executives of the group. So basically, there is, of course, the board members of the companies, but these are not the most important people in the business. Actually, the top executive meaning from the business perspective, right? So they are the CEO of the group, not on the particular companies. They are the chief of marketing executives, the development executive, and so on and so forth. Okay, so what we did for this client, of course, firstly, we needed to determine what is the actual IP, so the intellectual property. Because as I said, since it was a software development business, we initially thought about the technology, about the trademarks, about the application themselves that they were developing. But what resulted from the interviews that we had with the client representatives was that not only the applications themselves or the technology themselves that they developed was important, but also the marketing intangibles, also the support technology used to boost the sale of the apps. As you might know, most of the applications for mobile phones are free of charge. But then you are charging the client, the customers, for any add-ons, so any features, additional features that are input into the application. So the applications themselves, the software itself, is not used by the customers, is not as important as how to, for example, measure what particular customers, what particular users of the app want, which features with add-ons, which add-ons they want to use, which brings the most profit, which might bring the most revenues to the group as a whole. And also, what is also important is the marketing of this software, because what we often see in the mobile apps are the commercials of additional products that we can, just download to our mobile phones. And contracts with those owners of these additional promotional applications is also what brings significant amount of revenue to this capital group. Okay, so we needed to identify this intellectual property. Then we needed to consider what are the actual value drivers of this group. So I already mentioned that not in the first place, I would say that the software is the most important. But then it turned out that, for example, marketing and technological support are also of key importance. So we determined the business processes that are within this business and how they are, recognized in terms of the DEMPE analysis, because you need to convey the regular business processes within an organization into the DEMPE analysis to best allocate the value to the intellectual property and to the teams or entities that are dealing with the particular processes. Then what we were, while doing the interviews with the client, we discovered that, when discussing people who are, responsible for particular processes, who are the decision makers, they also have the significance in the business. So sometimes you have like a team of 50 people who are basically the software developers, but they are only the doers of the job. Whereas you have a CEO who is innovative, who is the founder of the business, and who basically he's a genius. Like, let's compare him to, for example, I don't know, Jobs or Elon Musk, who is the genius of the business, who is basically doing the key decision maker, and he's so innovative and so, you know, constructive in his advice to other business executives, so that he's one of the most important person in the organization. Then to double check what we did in terms of the processes in the organization and the people involved, we also identified the risks. Because also you know that sometimes the risk taking and the risk allocation is not aligned with, again, the processes being within the organization or the people involved. Sometimes even though we might initially say that one particular entity is taking the risk of the organization, ultimately we can find out that they are not able to finance the risk, or they have no people to manage or assume or control the risk. Therefore, the risk can ultimately be allocated elsewhere. Okay, and the final step that we did that Jimmy mentioned earlier, we used the RACI analysis, which is a modification of the RACI analysis that Jimmy described. I will move to that later on the next slides. Okay, so here it is. So basically what we did in this process of determining the profit allocation, of course, in this group, we conducted the value chain analysis. So again, as I said, we basically split all the processes within the organization into main processes and sub-processes that were allocated between entities, between people, between teams within those entities. And then we attributed the importance of the roles using the RACI method or the RACI analysis. The RACI analysis, as you see on the screen, is basically to allocate the different levels of responsibilities among teams or people within the organization. Because we might have teams that are basically doing their job as they are told to. So in this case, they are the people that are doing the tasks within the processes. There might be some people or some teams who are basically supporting the processes, but they are not actually doing the job, or they are not responsible for the job. So they are the supporters. There might be people who are only informed about the outcomes of the processes. So they might use this information for their own processes, but they are not contributing to this particular process that we are analyzing at hand. So they are the people informed. And then the two most important roles in this case are the people who are responsible for the process and the people who are authority over the process. Authority means they own the process, they are the ultimate decision makers, and they might be the ultimate risk takers of the process, right? So if the process fails, they are the ones who pay the price for the process, and they are also the main people, the decision makers, whether to go into the particular, I don't know, software development or whether to leave it at the I don't know, idea stage. Sometimes we discovered that obviously not in all the processes or sub processes that we identified all of these roles must be put, or sometimes we discovered that, for example, people who are doing the actual process or the actual task also are the responsible ones. So it was a challenge for us to determine which people, which teams, which entities to which extent are involved in particular business processes. Okay, so when we basically identified 5 key processes within this organization, which was production that was actually the software development, technology. As I said, these were like architecture of the business, the engineering behind the scenes, basically. So this was also one of the main processes. M&A, mergers and acquisitions. As I said before, there was a small team involved in M&A within this organization. But as we discovered later on, it was one of the crucial businesses because in software development, you can have many fails before you have like one or two applications that are globally successful and that actually can bring you money. And your business can grow organically, so basically within your organization, or you can grow by M&As. So this team, M&A team, was very important in this business because they were looking for like small software developers on the market who were not funded enough, but had a brilliant idea to develop a unique software, a unique application. And therefore this M&A team was crucial for development of this entire business for this entire organization. Then there was marketing. As I said before, marketing was also important because how to place the software, where to promote these applications, how to price these applications. This was also very important for their business, and ultimately IP protection. Again, as it was earlier said. A few years back or decades back, we would say that IP owner, legal only IP owner is the king, basically, right? So it is the most important entity within their organization because they have the ownership of the IP rights. Nowadays, we can see that, well, so long as the IP is protected, legally protected, and it cannot be easily challenged. So, for example, the patents cannot be easily challenged. It is not that much of an important role within an organization, and it definitely doesn't contribute to generating revenues of the organization as much as the other processes identified in this slide. Okay, so after conducting multiple interviews with the representatives from different companies of this group, we actually identified that the production and marketing are the most important processes within the organization. IP protection in this case gave us like 20% of the importance of the value creation of value drivers, technology 10%, and M&As 10%. Then what we did later on is that we also wanted to attribute these processes, as I said, into entities and and first into people and teams within particular entities. So when we did the ratio analysis, then we needed to find out what is actually the contribution of particular people for these particular functions. So for example, we said that if anyone is informed about the particular process, they do not contribute to this particular process at all. So we assigned a 0% value. But when there is a person who is actually doing the task, so this is not as much as important as being the authority or being responsible for the task. So as you see, the doers, which is the majority of the employee within the organization, are not that much important as the decision makers. And as a result of this exercise, we were able to attribute importance of the processes in the value creation. We were able to allocate the processes to entities and the people. We double-checked it with the risk allocation because, as I said, the risk allocation is not always aligned with the allocation of processes or people. And then finally, we were able to split the profits among the group entities. And this was the ultimate result. So as you see, company A, that initially we knew that had like only 10 employees, was ultimately said that this company contributes like 40% to the profit of the entire organization. Company B, which had the most employees in this case, contributed only 25% of the profit. Company C, 30%, and other companies, specifically thanks to this M&A function, they contributed like 5% of the profit. Okay, thank you. This is my case. If you have any questions, I'm open to them.
Thank you, Anna. Thank you so much. Now we'll pass with Jose, who's our transfer pricing specialist from Spain. Jose.
Thank you.
There you go.
Thank you very much. So the presentation. Okay. Hi everyone. Congratulations for your presentations. Actually, they are so good. Maybe too good for, But so basically, what I gonna talk about two profit split cases. Actually, residual profit split cases that we have faced. And we believe that, we struggle in the implementation process. So perhaps, we can just give it a thought and let's see if, some ideas come up. So, it's open for discussion, actually, So how is this works? Okay. So the first one is, so let me give you a little bit of background. This is a Spanish company that it was focused on cybersecurity. They created software, an IP, back in 2018. And at some point, they wanted to move to the US just because they were trying to look for investors and looking for a private equity. So this is kind of popular. The redomestication process. Basically, what they did, it was to convert the entity into a branch of the US entity. But there are some tax implications on this movement, and it's important from the transfer pricing perspective that especially the assets that has been generated before the redomestication process stays in the branch, in the Spanish branch. So that was something kind of very important for the definition of the transfer pricing policy, and especially for the attribution of profits to the permanent establishment in Spain. No? Basically, that is the transaction at the end. So it's a profit split in order to attribute the profit between the entity and the branch in Spain. So talking about who was doing what, okay, let's go to this functional summary. Basically, what we had is it was kind of interesting because before 2018, they have created a software that works really good, but at some point they incorporate a lot of new talent, into the equation coming from the US. They decided to change somehow the IP and to generate like a new IP. It was, they branded it actually with a different name, and they said that it was, even though the functionality it was kind of similar, it was completely different, or maybe it was only 5% it was common from the previous one to the new one. Okay, that gave us some kind of difficulty. So basically, what we had, it was, as you can see, we did this value chain analysis with a DEMPI analysis, with development, enhancement, maintenance, the protection. It was not that clear at that point because it was not protected actually in 2018. So as you can see, both parties were developing, but different parts of the IP, which makes a lot of complication. But the marketing, it was a big part of it in this particular case, because this is a software as a service, and basically what you have is a solution that helps a lot to the client. But if nobody buy it, that there is no value on it, right? So it was key that the biggest part of the investment of the company, it was focused on marketing actually, because it was not sales driven. It was just marketing, and basically what they want is, okay, the client has to download it by themselves and start using it. So we ended up like applying this residual profit split method. First of all, of course, compensating those functions that were benchmark. That you can benchmark, because that was routine functions like the support, the IT support, the administration part of it. And at the end, basically what we were it was splitting the residual profit between the economic property, the percentage of IP share, no? Which is the table on the right-hand side below. Basically, quantify the economic ownership or the split of the economic ownership of the two parties based on the cost incurred of intangible development cost and the evolution of it. So something that I think is very interesting here for all of us is like, I mean, in the example that we were discussing, I mean, you were like sharing a picture of, you know, the profit has to be split this way. But in the two examples that I want to share with you guys, basically what we are seeing is that those percentages are evolving through time. And Marco, I mean, he was highlighting the importance of the consistency on the transfer pricing policy. That doesn't mean that the percentage has to be exactly the same. We need to have a proper criteria to apply it, and probably, you know, is the case.
I want to comment on that from my case, because I do fully agree with you, because in my case, we did the interviews at the particular moment in time. When we went back to the client 1 year later and we reevaluated our analysis, the split of percentages was slightly different.
Yeah.
So the businesses evolve constantly. They are not like fixed on a permanent basis. So I do fully agree that the split of profits might different and actually will different. Basically determined, for example, in my case, where they laid off one of the executives and they hired a new person from a different country, which meant that this shift of profitability, because the shift of contribution changed, and therefore the shift of profitability. Yeah.
Yeah.
That's an interesting point. That you, because if you then see that the profit share shifts, you also then have an exit taxation, because
we were considering this issue, whether there should be an exit taxation.
Yeah. Apologies for.
No. Actually, I think this is the best part, actually. So go ahead. So basically, yeah, I mean, that was interesting. I think it's like a dynamic evolution of how the IP share is gonna be alterated. And it's very interesting actually for the client to understand the transfer pricing policy, not for splitting the profit today, but, you know, for splitting the profit tomorrow. Actually, this company, you were talking about the difficulties of the losses. I mean, by the time you are facing a loss situation, I mean, actually, this company was facing losses and we were splitting losses. But the thing is, with that evolution, basically, you can tell who is going to be, you know, the winner at the end of the story. In this particular case, basically, the US was investing a lot, not only in the marketing part, which, you know, was only, as you can see in the summary of the functional analysis, was focused only on the US entity, but also on the new IP. So that was some kind of substituting the previous one. That was also interesting because basically we ended up like having a license of the previous IP to the new IP, because, you know, we ended up like concluding that maybe this 5-10% of the new IP was coming from the previous one. So we have to compensate the brands and recall the redomestication process and the importance on compensating the initial IP, which was that one. So by the time we face the split of the residual profit, compensation, as you guys already know, this is not new for you, is very common actually, and is a well driver to measure the value contribution somehow, because I mean there are certain considerations that we should have in mind, and one of it is the historical cost. Okay, so basically, I mean, we go there, we have, you know, the employees and the compensation base for corresponding to the employees, but the thing is, okay, how about the know-how generated by this team in previous years? So that's the intangible development costs. If you have considered it that way, or maybe just to account somehow, in this particular case we did it like, okay, how much has been incurred in the development, enhancement, maintenance of the first IP previous to the redomestication process, not only the picture of fiscal year 2018 but previous years. So yeah, it was interesting because, I mean, we were facing like co-development. I mean, normally in these particular cases, we have like an IP owner, which is pretty clear. With the DEMPI on the table, it's not that clear anymore. And in this one, it was like that. It was a co-development and the co-ownership. It's interesting how to deal with the third-party cost. Is okay, the third-party cost, there are value on them, or there are no value, is third-party cost. Okay, if it's third-party cost, we should take that out of the yeah. Okay, so I think the other point has already covered. Do I have 5 minutes more? Yeah. Okay, so the other case is so this is Spanish. Well, it's a multinational group with presence in Spain that got a contract to build the construction of an energy plant in Latin America. I mean, the example is in Argentina, but you know, we changed the information for confidential purposes, so it's not Argentina anyhow. So the thing is, so basically, the summary again, you know, the functional here, it was that the commercial activities has been driven by the Spanish team. Basically, they were like focused on getting the project. They didn't have presence in Latin America till they got, you know, the project. The procurement, I mean, all the equipment were coming from Germany, actually. You know, it was another intercompany transaction, but out of the scope for the purpose of, for illustration purposes here. The engineering, I mean, mainly was in Spain, but the supervision, which was also with a high, it was a curd function. It was local as well, okay, and the management support, which it was routine function. Okay, this is kind of clear picture, but the difficulties that we found in this equation, it was linked to the fact that we have a multi-year project. It's like a 5-year project. Okay, so basically we did a residual profit split. Okay, first of all, the routine functions compensated. Secondly, it was the commercial, the procurement, and the management support. Okay, once that has been compensated, because we have like different references. I don't think the internal caps here is necessary to discuss. We ended up to splitting the profit, and for splitting the profit, it's very interesting because we need to split the profit on a yearly basis. So in this particular, I mean, in this industry, you will get different levels of profit on different years, and depending on the level of compensation, again, because in this particular case we were using the compensation base, the split of the profit will be one or will vary very much. So we ended up like finding out that if you I'm playing with some financial projections for the 5 years, you ended up with different profit splits results depending on if you split it on a yearly basis or on a pluri-year basis. So this open a question. So is how the yearly cost impact on the attribution of profit. Okay, so I mean, we were talking to them, and in this industry, it's very common that they have this risk of the project, and they make a provision, but at the end of the year, if the risk didn't arise, so they have like an extra income. If they have this extra income, you have a huge profit that year that has to be split. Maybe the next year is not going to be the case. So you ended up like having a completely different result. So that was the first question. The second question is, should the profit split be based on overall cost of the project? I mean, not only on a yearly by yearly basis, but on the overall cost of the project, in case we are talking about compensation-based project. And could an end project adjustment be applied? Which we believe that is the case, and you actually can adjust the profitability based on the expectation of profit of the overall project, and which entity will be entitled to the profit that derived from the reduction of cost. This was very interesting as well. You know, it was in this industry, you can have like a huge benefit or a huge loss, just depending on how variable you are gonna be based on the budget that you had, and who is responsible, who is the one that is leading or is achieving those benefits. In this particular case, the profits are very high. It's completely the opposite to the first example, in which we have a lot of profit. We have to split the equation, and yeah, we ended up like concluding in this particular case that the engineering and the procurement team that was located in Spain in this particular case was the one responsible of the benefit or losses or the deviation from the budget. So basically, these are the takeaways of these two cases, which is not more how to apply the methodology, but some difficulties on the implementation that maybe we can face in a multi-year profit split type of analysis. So,
thank you. Thank you so much, Jose. Now we will have Peter Hepp from UHM.
Thank you. So still not my presentations. Anyway, I will not show you a case, but more principles of the German application of the profit split, meaning, here we are, perfect. As you all know, the transfer pricing guidelines said that this is more a question of business judgment and not science. And Germany took it over and said the determination of transfer price is not an exact science, but requires a reasonable judgment in each case, which helps sometimes when you deal with German tax authorities, just to tell them it's not exact. It's more or less a judgment or estimation. Perhaps let me tell or stress something with the German tax authorities environment. We are a high tax country. We lost, as you know, 2 world wars, one reunification, have a very high social security system. So that costs a lot of money. And the German tax authorities have one objective, just to get returns on what they do. Yeah. They are paid sometimes for what they do. And that's the environment that we have to deal with. A lot of mistrust or mistrust. We have a lot of fraud investigations every second time. The amount that is shortened is we deal with tax fraud investigations. So it's a totally different atmosphere that you normally deal with in tax situations in other countries. The hierarchy that we have is, of course, the standard methods. We call it standard methods, and the profit split methods are subordinated. But normally I deal with DNMM and some PSM transactional. No global PSM, of course, is not allowed in Germany. And we have some specialty. It's called hypothetical transfer price, where 2 persons, like playing one person playing chess with with itself. Yeah, you have to deal with yourself. You have to find a price, a transfer price with yourself. I've never seen that in practice, and I don't know if any other country has such a regime or standard included, but it's part of our law. This is the typical understanding of a German tax auditor. Production, yeah, an industrialized company and head office and distributor. That's what they expect. But the reality, of course, is different, as you know. The reality is you deal with complex, as we saw in your case studies, as we saw in your case studies, we have complex enterprises, we have complex situations, so that doesn't work any longer. But when you look at our decrees always qualify enterprises either as routine or head office, or even more, we have hybrid enterprises, which is a German anomaly. Hybrid enterprises is a form in between what nobody else has, and I normally don't deal with it. Here we have some definitions. And one typical problem we deal with in Germany is when you agree on a margin, like 3% for the distributor, and at the end of the year, you come out with less or more of 3%, let's say, of the turnover, all of you would probably make an adjustment. Yeah, this is, the Americans do it. Yeah, all countries I deal with do it, but not in Germany. We don't have that outcome approach. We have a price setting approach. You never heard about it. We say in Germany, you have to deal with it. If it's 1% or 4%, that's the way it is. No adjustment payment allowed. I don't know if you know.
I mean, we have a similar approach, but we modified it a bit because we also have a price setting approach.
Yeah.
But so long as you set the price correctly, I mean, with the conditions set at the very beginning or at the time when
Yeah.
you're price setting, then conditionally the year-end adjustment or end adjustment is allowed, so long as you have it justified. For example, due to some external conditions, external situations that you could not have taken into account at the very beginning.
That's what I say here. Adjustments are only accepted if they were accepted at arm's length as well. So what we do normally, we do short-term contracts and do adjustments, roll forwards during the year. That's the only way we can do it. But it's not very well accepted everywhere. So probably this is an anomaly in the process.
We probably took it from you.
Yeah, Germany tends to export the ideas like. Yeah.
You mean that? Thanks for that. I'm not sure I understood properly. You mean that in case in the agreement between two related parties, say the target margin would be 3%, if at the end of the year we do not reach this 3%, even though your adjustment would not be accepted by tax authorities? Okay. All right. Fair enough. All right.
Another question?
Yes, and on what basis is the 3% decided?
Yeah. It's just an example. Let's say, yeah, they agreed on a database research that 3% is sufficient. So yeah.
So my question is more in regards to the industry. So for example, is it based on industry to industry type of the transaction? Within the
Yes.
industry, and is
Yeah.
it fixed across?
And it's fixed. Yeah. Normally it's fixed. That's the German approach. Because we have some persons in the German Ministry of Finance, we were happily, he was sent to pension, and we thought, oh, no, it's gone, the price setting approach. But the next decree included it as well. So
So in that case, then there wouldn't be any audit, because if the percentage is fixed and if the companies are.
no, that doesn't mean that we don't have any audits. The 3% is checked in a tax audit, of course, in multinational companies almost every year, but 3 years after the events, after the year was closed. So another typical German problem is when you have a range of of values from a database, you have to narrow it, meaning you have to look what is outside the second quartile, what is below the second and third. This is the second quartile, this is first quartile. What is below the second quartile, it is cut off and you cannot use it. What is above the third quartile, you cannot even use as well. And when a tax audit is conducted and they come out that you are outside the quartiles, they correct it to the median, unilateral. Yeah.
So no full ranges are accepted in any way?
No, never, yeah. It was first in the decrees and then they thought, okay, we put it into the law and now we have to deal with it as well. It's something that is very strange when you have work on a multinational.
It's difficult to provide the arguments not to apply the median in the Netherlands as well.
Yeah. So that's my very short presentation here on German taxation, German transfer pricing. If you have any questions, please feel free.
Thank you. Thank you very much, Dr. Happ. Well, ladies and gentlemen, that was quite interesting, right? I know most of you will have comments or questions right now. We will have like 20-25 minutes in order to do so. So feel free to ask any questions to our incredible panel. It is also open for the panelists to comment on others as we were doing it. So there's any participant that have any question, comment that would like to add? Yes.
Thank you. What is quite obvious in all the transactional profit split cases is that the question how to transfer in contracts on one hand, and in the case of an APA or multilateral APA, how to define the critical assumptions. Taking into account that most of the cases you presented all together are business driven or people business driven in terms of key entrepreneurial risk taking functions. So they may vary from time to time, yeah, especially in the software development business. For example, if you have a key developer, for example, yeah, the racy guy, yeah, who has all the functions which are important for the value contribution. How do you deal with these changes and these challenges in terms, again, in signing or building up a contract or contractual relationship based on this transactional profit split method, and again, in terms of critical assumptions if you're going for a multilateral or a unilateral APA?
I may answer your question. So basically, in my case, we agreed with the client, and we also, actually, it's a very good point because my client is actually under a tax audit for this particular case. So we agreed with the client that basically this is a very fast developing business and very rapidly changing business. So basically, you could do the profit split analysis on a monthly basis or quarterly basis, and the result would be slightly different. So we agreed that basically you have to take a reasonable approach to that. And so long as there is like no significant changes in the profile, that there shouldn't be any change in the profit split, but you need to, review the split of functions every like year or every 2 or every 3 years, depending on the dynamic of the business. So with this particular client, we agreed that every 2 years adjustment or every 2 years review should be sufficient for them. Otherwise, they would be constantly under the profit split, modification, analysis, and so on and so forth. And what we also did is, the more people or teams we investigated and applied this, attribution of even small particular contribution to the profit, because when we were investigating or we were interviewing the people, we arrived at the result that, for example, there are like only few people who are contributing more like 3% to the profit split. So they were like the significant persons. And the rest of them were like 0.001 and so on and so forth, because we had a huge Excel matrix who actually point by point allocated this contribution. And then we generalized basically. So we said, okay, this may change from time to time, but let's assume that so long as there is no change that bigger than like 5% of the profit allocation, we are leaving this as it is, because otherwise we would go crazy.
Yeah, thank you. Just for clarification purposes, I tend to imagine the documentation situation in these cases varying from year to year. Yeah, if you are build up your documentation on an annual basis. Yeah. How to deal with these assumptions you mentioned before, yeah? If you have a kind of bandwidth, yeah, or kind of flexibility built in the system, yeah? How to deal with these variances from time to time, yeah? Without any adjustments from the outcome.
Yeah, so we basically related this to any significant changes in the organization of the group. So if there are any reorganization in terms of, structure of the group, so like teams, like responsibilities of the group, if there are any significant changes, then we look into the profit split once again and try to think if there should be any change.
So the Red Sea methodology you applied is not focused on people or special people, but more or less on companies or entities.
I mean, people and teams within those companies. Because the teams, for example, teams responsible for marketing were situated in 3 different countries, and they all combined one marketing team, the same as the IP development, the same as the IP protection even. So they were, located in different countries, in different companies. Therefore, you had to combine them and then, put this matrix on top of the actual countries that the entities are residing in, and then deciding whether the change is that much significant.
In terms of translation into a contract,
the contracts were pretty flexible, because I mean I can elaborate on that, because we were now discussing very theoretical, or I would say quite theoretical approach to the profit split. But then again, this is a very good point, because you need to transfer this into the contract-based analysis. So what we actually did, we applied also collaborative methods, meaning basically the cost-plus method. So we used the multi-year financial data of the particular companies of this group, and we looked at this data in terms of what if we do not use the profit split method, but rather the cost-plus method for particular lines of businesses, for particular services within this group, and whether using the cost-plus approach, the outcome of the profit split within the group would be similar or different. So, for example, for this, in my example, for this company B that employed like 250 employees and was involved in basically in the development of the software. Before our analysis, they were using like cost-plus 7% markup. After our analysis, we told them, if you use cost-plus 15, the result of the profit split in a multi-year, approach would be more or less the same. So, for example, by increasing the markup over cost in the particular entities for particular services that they were providing, for example, to the head office, we arrived at a more or less the same outcome as the theoretical approach of using the profit split method.
One last question to all the speakers how do you deal with, let's say, with spillover effects or synergies? in this regard, especially in your case. I remember, or I could imagine, for example, if you have this kind of entrepreneur in company A, if I remember correctly, and you have the development people and have also some the marketing functions. Yeah, I think the key value driver or the key value of this business model are synergies, more or less. How do you deal with this effect from an economic standpoint?
Okay, so this is again coming back to the initial point that we just discussed. So basically, you're doing the reviews of basically the evolution of the teams, of the organization, of the people within the organization. Again, interesting point, because in my group, the group took over a new company a couple of years ago that introduced a significant input into marketing development of the entire group. Change was significant because they did have a synergy between this new company that was introduced to the group with the already existing companies that were dealing with marketing. And actually, this new company brought a significant, input into revenue generation of the group. So therefore, the shift of the profitability changed significantly due to this company. But then again, you could not forget about the marketing that was did before. So yeah, it was a challenge, but we thought that you cannot be like perfectly accurate in allocating the profit. You should have made some assumptions. There obviously will be a mistake. There obviously once, for example, this is also a challenge. Like with, for example, hard to value intangibles. When you measure the profitability afterwards, it can be different than what you assumed at the very beginning, but it doesn't mean that your initial assumption was wrong. This was just based on the facts and circumstances that you knew at the very beginning of your analysis.
To a certain extent, of course, it will follow from the RATSI analysis how the synergy effect should be divided. If it's clearly to which group of people the synergy effect can be allocated. In many cases, of course, that's will not be the case, and then it's just divided within the total profit split. I think within Europe, US, it will be less. I think, but for example, you also have the location savings. So, and that's much more difficult to deal with, especially, for example, in cases with China, where for example, production costs are much lower. And then the question is, well, should, for example, Europe or US benefit from the location savings in China? And for sure, that's also mentioned in the United Nations manuals that China is rejecting that benefit for the US. And to add on the change, I think relating to your first question, I think generally a benchmark, at least in the Netherlands, accepted to be applicable for 3 years. It's our view that a profit split analysis for that purpose should also be undertaken every 3 years or renewed, and you try to describe the system as much as possible in the documentation, and only if there's really a reorganization taking place, that's something which you have to document in your master file and local file, then you might need to update the profit split in the meantime. And there's always a magic wording in the APA or bilateral APA that if there's a significant change of facts, then you have to inform the tax authorities, and then you just have an open discussion with the authorities again. But they also do understand that it's too time consuming to update such a RATSI process each year, because it's a massive process.
Thank you. There's any other question? We have some couple of minutes. Thank you so much. Go ahead.
Yes, it was. Thank you very much for your presentation. It is both an interesting and a current subject, I think. As an old school TP practitioner, I always recommend my clients to implement the TNM method, of course, as soon as a CAP method can't be implemented. But what I realized in that new post-COVID-19 economy is that clients have more and more questions about an interest to implement that profit split method. So when we are speaking about the profit split method, the first things that come in mind are, of course, business integration, common contribution, and then when speaking about the allocation key, of course, we focus on function and asset. But don't you think that market conditions could be a driver as well? And especially about high-level profit industry. Let's take an example. I have a concrete case on the trading of energy market, and with the war in Ukraine, of course, I heard the manufacturing cost has been multiplied by 3 when the final price to customer has been multiplied by 10. So in that concrete example, do you think that it would be okay to grant just a 5% margin to the LRD or 10% at the beta? Because probably I don't. It's both unfair from an intellectual point of view and uninteresting for the client. So if it makes sense not to use the TNMM in that concrete example, probably the profit split method may be a solution. But of course, when we have to pronounce ourselves as a council about the allocation key, the DMP analysis won't be of any help. So do you have, in this kind of case, any thought about a clever way to share profits?
Well, I can answer that easily because we had this challenge with when discussing with tax authorities, maybe not based on the current situation, but historically as well. Well, this is why I already said that we, for example, use more than one method to double check what should be the correct profit allocated to the particular entity. For example, as you might know, Poland is the country where many multinationals located their businesses, but located their subsidiaries, allocating them with a cost plus or a resale minus minimum margin because, we were not the IP owner or the knowledge owner rather than the hands and, and brains to do the basic works, right? So the basically the manufacturing plants or the shared service centers allocated with the cost plus method. And as Jose, for example, shown, the allocation of the IP, the development of the IP, the knowledge might evolve over time. And for example, the teams that were, initially only cost plus teams may also be more educated and more involved in the decision-making process. Therefore, you can apply more than one method. So as you said, TNMM method is the basis method to use. But then if you have like extreme market circumstances that allocate more than significant profit to the group as a whole, you can discuss and investigate whether more than the minimal profit should be allocated to this particular entity, because we do need to remember that a low risk entity doesn't mean no risk entity, right? And this is the key point in this analysis. So if you are allocating 5% on a regular basis to a particular entity on a cost plus or TNMM method, but there is a year when there is a huge additional profit allocated to the group, you should consider whether there should be an extra premium also allocated to this particular entity. So I would use a profit split method as a corroborative, supportive method to decide that whether there are some significant people function or significant processes within this limited risk entity that should also be awarded an extra profitability even for a year or two.
But at the same time, in the concept, I find it difficult to change a routine function to an entrepreneur due to the change in market circumstances, because that's typically the risk which is taken away from the routine function. And of course, you see it happening in your case. And the example, for example, there's a Nike case brought forward by for the European Committee, where Nike is very big in the Netherlands, but remunerated on a cost plus. But then the argument is that over time there was local marketing IP created, which allows perhaps the argument that over time it became an entrepreneur, but just a change, for example, due to the crisis in the Ukraine. For me, that's a difficult one. I think the Dutch approach would be that would be a reason to deviate from the median in your benchmarking analysis and go to the upper quartile, because that's a thing I think business people will do well. If I'm doing well, I do allow you also to benefit a bit from it, but not too much. But ultimately, you should have to demonstrate that it's really joint entrepreneurship, which is taking place before being able to apply the profit split method.
But I have an additional comment to that. I would say that as you said about the German rules, for me, the transfer pricing world is not a black and white world. So we do not have a purely, routine functions and purely entrepreneurial functions. We might have a mix of that, especially due to the fact that we, have a globalized world more and more, and some top executive or more experienced people may be employed from the organizations that are previously known as routine organizations. And then you have this challenge whether they are contributing also to the profitability of the business of the group.
I fully agree and also accept the hybrid system. But if something is routine by nature and there's a change in market circumstances, that change as such does not make a routine function a hybrid one. But of course, if you're a routine, there's of course always the risk if the market circumstances change that might consider the routine function. Well, I can do that better myself and take a bit more risk on me and become an entrepreneur.
Agreed. Yeah.
Just one comment to this. It's quite interesting. It's not only the differentiation between routine and hybrid, so to say, or for example, but if we rely on the bargaining power of the routine entity, for example, and the realistic available options for the counterpart, that gives you the opportunity to argue that in terms of bandwidth, you are on the upper side of the bandwidth. Again, and therefore also as the Chinese does frequently, that they argue we have that negotiation power due to the market entry to a 1 or 2 billion people market, which is valuable as such, and we have the negotiation power so far, and you don't have any or for you, no realistic options are available to go into another market. So therefore, they await surplus on, let's say, on the median or whatever the outcome might be in terms of a routine benchmark.
Sorry,
I had one question as well.
Sorry. We know we don't have much time for the Q&A. We will accept one last question. I know many of you have plenty more questions and comments, but we will have a coffee break where you can talk, entertain the last question, and then we will go to the coffee break. Please.
Okay, thank you so much. On your point in terms of, obviously transfer pricing is not black and white. It has a subjective element to it in terms of the economy, in terms of the industry, and the way tax authorities are responding to anything. The RASI or the RATSI processes, how the subjectivity involved in that side, in terms of how do you quantify the processes, like the control or the authority? What is the process of even quantifying it? Is there a base of comparability attached to it, or how do you define the percentages on that?
Thank you. That is very, very, very valid question. It was actually in our process, it was the most subjective point of our analysis, because there is no comparability to that. I mean, I don't know, I don't recall any. So basically what we were doing, we were actually discussing with the business, with the client, based on the discussions with them and looking at the processes from multiple levels of authority within the organization, we arrived at the level of the split. Because initially, for example, we were discussing the processes within the organization with the middle level management. And they told us that their roles are actually the most important ones. Of course, this is a human thing, right? When you're discussing what is your role in the organization, you will always say, I am the most important one. But once we were discussing, we were confirming this analysis with the top executives, they had like a higher overview of the business as itself, and they were seeing not only the risks involved with the particular processes, but the entire organization. They changed our approach to this split. So what is important is to discuss this again with the people from different levels of authority within the organization, then comparing it to the actual risks taken by the organization. What was also important is whether the risks that we identified were actually materialized in any way, or could be materialized in any way over the historical, results of the company, over the processes that were involving in the company, and then we arrived at, for example, some of the risks that were highly identified, like for example, IP protection risks, were never materialized, or were so easy to manage that basically they were not as important as other risks identified. But no, unfortunately, I do not see any comparables that we could use here.
Thank you. Thank you to all of our panelists. Thank you for your time. Thank you for all the information and comments that you will have. Right now, we will have a coffee break for 25 minutes. And then after, we will have an amazing workshops with our friends of Enterprising Solutions. They will introduce a workshop for all of us. So please, let's take our coffee break and then come back to our workshop. Thank you so much.
Work for a very large multinational company, which has in the internal authorizations that they either have a 4I principle and that they do have very strict rules whether certain thresholds in amounts are exceeded, which of course can be used to applies to objectify the RATSI process.
This would be great. But for example, in my example, this was actually the business.
I had a follow-up question.
Okay, sorry.
Yeah, no, we are following up on your question as well.
Okay.
Because there are ways to objectify it. It depends a bit.
If you have a KPIs in your organization.
So if the company is big, they work with KPI or very strict rules on authorizations, strict amounts for principles or not, then that's an indication of how relevant it's felt for the management to be that people are involved, informed.
And is that accepted at the national level?
We are still, discussing this with the tax authorities because it's relatively
Because I mean,
to approach this matter.
one, because of the subjectivity, or I mean, at least in my experience, when I deal with the tax officers, they always want to have something concrete to back your argument up. So what do you use this question? You're always leaving the room.
over time adding all kinds of modules relating to the management of agreements, managing of processes relating to the whole creation process of the documentation. But also CBCR has taken off as well, especially for the larger multinationals. And also since a number of years, it has been a thing where advisors were saying, well, you use it for multinationals. Maybe we can use it as well and create different environments for different clients, that we don't have the same copy paste exercise with all these risks associated with it. And you don't want to see the name of a client in one report and the same name appearing in a different report because something didn't work out. So we made some minor adjustments to the tool to be used by advisors as well. Of course, without disclosing all our clients that we have, there are a couple I can name and some we have on our website as well. So I don't know if we can show the screen that I have here. Hopefully it says no signal, so it should be coming soon. Yes. So we have a nice little website where we have some customers there. So some I can name here, but some not. But we have them everywhere. So companies like Heineken, AkzoNobel listed companies are more well-known names. And from the advisory business side, we have some advisors that are a single transfer pricing advisor, maybe in Hong Kong, with a couple of clients, to recently also some Big Four that are interested and sometimes even using the tool, and a lot of companies in between as well. So this has been taken off, and one of the things that we like to take from this as well is your valuable input as well. So if there are things that you see or things you would need in your practice, it's also good to have this type of interaction to make sure that we can offer a product that is really helping and is able to serve you whatever jurisdiction you are. So one of the things that we've been doing in the last couple of years is adding all these modules, and one is a translation module. So you can translate your local file in, for example, Spanish or maybe even Japanese as well, and Italian as well, and making sure that if you have your Italian document, it's also in the right template, because in Italy they always like to do things just a little bit different than the rest. So we need to accommodate that as well. So I'll be showing a couple of things in the tool that we have and trying to interact with you and answer any questions. So it's not just a workshop, but there's going to be some interaction here, hopefully as well. And I'm happy to answer questions that you might have, some during the presentation, but also after this session as well. Maybe it's good if Arjen does a short.
Yeah, hello. Nice to meet you, everyone. My name is Arjen Rommens, CTO at Intrapricing Solutions for 13 years already. 13 years ago, I started as an IT guy. I'm a software developer. I knew nothing about transfer pricing. And then I met Steve and the other partners, and we started to develop a tool. It was at first a very simple mail merge tool just to generate Word documents and insert some variables. And in the past 13 years, the tool grew out into a very mature transfer pricing documentation creation and management tool. And we did this with the valuable input of our clients. One of our first clients was AkzoNobel. And together with AkzoNobel, we were sitting and the transfer pricing manager drew like a black box on a whiteboard, and he said, well, we have this input, and on the output, we want to have local files for all our local entities. And then he said, Arjen, good luck with that. Here's team. We're like, okay, how are we going to do this? This is like very difficult. And in the past years, we developed and worked on it myself, but also our development team in Armenia, really smart guys who are helping with the software development. And in the past year, we created this tool, and I learned a lot about transfer pricing on the go.
He's almost a transfer pricing expert.
I'm almost an expert, but please don't ask me too difficult questions. So yeah, we developed this tool, and yeah, I want to say, so I'm very proud of this. It feels like my baby. It's like I nurture it, I work on it, and I really like to get input from the clients. We build lots of different modules on top of it, and I also see some trends towards the future. For example, ESG, which is more and more becoming a hot topic, or CSRD related topics, or Pillar 2, of course, which is like a huge mountain in front of us, which we need to walk towards. So yeah, we're very happy here to be here to show you our software, and also, yeah, if you have any input or advice on what we can add or adjust, then please let us know. Thank you.
Yeah, maybe to give a short introduction for the people that are not yet familiar with the tool. We already did a presentation some time ago on some of the functionality of the tool. Basically what the tool does, it creates all kinds of documentation, and how it does that, it brings together certain parts of information that are crucial in order to create the transfer pricing documentation. And in order to do that, it's required to have information on the legal entities, where they're located, and of course that can result in maybe a different template that you use. So if you have an entity in Italy, then the tool knows, hey, Italian entity, let's do the Italian template. But also other information like who are the key people there, what are the most important functions, maybe also relating to CBCR kind of topics. But what we also try to do is make it flexible. So in a way, it's a tool with some complexity in order to make it usable for everybody. So if we have people that say, you know, I want to have the share percentages of all the entities included in there, or who are the persons that are authorized to sign off on documentation, I want to have that information in there, we can put that in. Another part of input that is important is having the right document templates. So as we work with a number of advisory companies as well, we see a lot of content which is the same or following Action Plan 13 type of topics, but we also see differences. Again, those differences can be a result of differences in country legislation, or just differences in company culture. So if I look at a report from KPMG or EY or another big advisory firm, I can see differences there. And I can sometimes see, okay, this probably comes from the people in the US where the report was made, or from Germany, or from the Netherlands. And if you're collaborating with a lot of people over the world, you sometimes try to have the same identity, but also respect the local differences in how people like to do their work. So we take that into consideration. So we can add the logos and the colors of the document to make it look like, you know, you have this input and with the press of the button, you have your EY logos or any other provider's logos or your logos. So that's something we try to tailor. So we're not that we want to have our big brand on every report. No, in the end, it's going to be your work that will create the output. The other thing that we use as input are transaction information, so all kinds of transactional information, defining the different intercompany transactions, the information that you need to put in there, like the financials. But also if you do profit splits, a topic that was just discussed as well, that you can do more thorough analysis of all the functions, the risks and the assets, make an allocation to be able to do that in an efficient way, and also try to visualize some of that. So not only to have things in Word and written, this is how we sort of started out, as Arjen said, the document generation, but also have more visualization in order to get a better understanding of the entire picture. So these are things that I'll be showing in a moment as well, that have been part of the development process and are ongoing in order to create the right output and the best user experience. So maybe if I can touch upon a couple of the topics here, I will show you here our dashboard. So this is like a dashboard for somebody who's managing all kinds of functions and features in the tool. Of course, when you have a multinational and you have people that are only required to give local input to, let's say, a particular transaction and only for their country, you don't want to basically overpower them with too much information. You want things to be precise. The same thing if you are a large advisory firm or even a smaller advisory firm where you collaborate. Sometimes you want to separate the files. Remember, we have some clients that have offices in the US and Germany where the Germans were saying, no, we have our privacy regulations. We cannot have the Americans viewing our documents, even though they might be working on the same documents. So those are things that we need to be able to accommodate as well. So if we look at the system and we look at user management, this will be something that we can change. So here we have somebody that only validates intercompany agreements. They will see the agreements that they need to validate. They will see a calendar and they will see, well, they have not been doing so well because they are in the red. So this means there's work to do, and of course some guidance text and welcome text to help them. So we try to be flexible in the approach as well. So if I go to a couple of the items that are relevant for input and some of the features we developed, if we look at legal entity input, so we try to be able to make that flexible as well. If you want to upload in bulk, we can do that with an Excel. We can import, export, and that makes the process a little bit easier. It's even possible to have certain downloads from ERP systems in the right format. You connect it to TP-Genie and you have the information in there. So if I take just one of the entities here, this is some of the functionality that we will see in the tool where you have your address details, the location of the office, maybe somebody named Jane Doe from the supervising board. And probably the people will recognize some information for CBCR here as well. So we try to connect all these little puzzle pieces, and sometimes we flip the puzzle. So you can have one part of your documentation looking at the front, and if you want to make some CBCR, you use the same information, but then you paint a different picture. And you see a lot of question marks here. So we try for the users to give a little context and maybe some quick tips on the fields as well, in order to help the people that are working with the tool to understand what they're actually required to input. If we look at how this is used by advisors, we see a lot of different uses as well. So in some cases, the tool is being licensed by the multinational, and that can be either on the initiative of the multinational itself or the advisor who's very familiar with the tool. And you can collaborate also with your client. So if there's sections where you can have your client providing the input or have access to certain parts as well, to not go back and forth all the time with emails and saying, no, I want to make this change in paragraph 3, then this will be a way to do that as well. So you can give some limited access to the client and let them provide the documentation, the content, and also take some ownership there. So what we also see here is that you can have a list of who is authorized to have access to this type of information. And you can restrict that. Do you want people to view information? Do you want people to make some changes as well? And decide whether or not things are in or out of scope for certain parts of documentation. So that will help as well. So sometimes we see entities being put in the system that are only there for a sort of consolidation purpose and to aggregate information, and then you don't need to generate a local file, but at least you have some relevant input there. If you look at the top, we can add information on deadlines. Of course, these can be country deadlines. but it could be your own deadline. What we see is with especially companies that operate in many countries, there are significant differences in deadlines. Usually what people in the year stress about the most in the beginning is Poland. If they have entities there saying, no, we need to get this first done and it needs to be in Polish, so we need to hire a translator and it needs to be in the right format. So this is usually the thing where people start stressing first. But more recently also Denmark has been waking up as well. So we see a lot of requests coming from Denmark, especially after the summer. Where people thought, oh, I need to make sure that everything is in order there. And last week, I don't know if people were hearing that we were coming here, but I've been receiving mails and calls saying there's going to be an audit in France. Can we go over the documentation and can we translate that in French, and do we have all the most recent attachments available? So my whole last week was already preparing myself to come to France. And these are some of the trends we're seeing. So more attention with tax authorities for transfer pricing documentation, more attention within multinationals as well for transfer pricing documentation. And with that, an increased difficulty of finding the right people to aid those companies in creating the documentation, but also maintaining it. So one of the challenges that we see for both advisory firms and multinationals alike is having people being able to take ownership on the process and being able to manage this as well. So for us, it's maybe also a thing to spread the good word that the work that we're doing is also interesting. We get to learn a lot about different companies, how their businesses operate, in a way a look inside of their factories and their supply chain, and understand how basically the bottom line is being generated over the board. And I think it's good to create some awareness of that also with some other people, that this is a fun type of profession, that we should have more people in there. Now going back to some of the functionality that can aid in managing those processes. One of the things here you see are, besides the deadlines that you can click on when is a task completed, very simple click of the button, but it can make a big difference in stress level for a lot of people to know that at least somebody clicked the button, and hopefully that when they look further that the information is there as well. So these are just some of the things we get input in what companies like to have and see. And that will help to connect with this nice little dial to go from red into green and to make sure that you're in control. And the same would apply on the level if you are an advisor with different clients. Do we know what the most important dates are to get things finished? Who has the ownership of it? And are we on the right track? We have a couple of other cool features. Again, if we look at describing things not only in Word, but also in pictures, if you look at the legal entity details, where we can add FTE information. So here we have like a total number. I think if I go here, we can split it. So it's nice to have this input, but it's even nicer if we can visualize this information. So let me go a little bit up again. So this is one of the macro functions. So pictures sometimes explain things better than 1,000 words, and these are some of the functions that we developed. Maybe Arjen can elaborate on.
Yeah, this is a great example of one of our clients. They were they had a problem that they constantly were creating transfer pricing documentation. They had to create organigram, like these kind of visualizations in Visio, copy paste it into the documentation, and it was a huge burden for the client to do this for over 600 entities. So what we did, we created a feature to import these kind of numbers via Excel and it's just exported from their company book, from their local systems, imported in the TP Genie, and the system now generates like automatically these kind of graphs, which also can be inserted in the local file documentation generated by the tool. So this is a great example of some of the features that we recently developed in order to, well, simplify your life and the life of our clients in order to it's a huge reduction of time spent on creating local file documentation.
And not everybody is good in creating these things. I think I speak for myself as well. When I was working in a Big Four and they said, you know, make some nice pictures, I didn't expect to be making all these graphs and all these kind of images and supply chain pictures as quick as some of the other people. So this really helps there. On another thing that we can do with this, if we have information on ownership percentage, we can make like whole nice Christmas trees with who are the owners. Or if there's a person who needs to document ultimate beneficial ownership as well, where there's changes or stock options being granted, we can create documents with that as well. So in a way, this is not like core transfer pricing, but the funny thing is that there's a lot of data and information that you put in transfer pricing documentation that you can sometimes use for other purposes as well. And I think in the future, where we see a focus on, for example, emissions of carbon dioxide as well, and describing the environmental risks as well, that there will be parts of information inside these tools that can be used for creating such compliance documents as well. And again, you can add some kind of nice attachments. And one of the things that we do is add information that you can integrate in your local file as well. So we try to be efficient and not have again too much copy pasting, but take the basics. Which points do you need to cover in your local file? Have a good template and adjust where needed, and then for the next year migrate that and use it. So I don't know if any of you sometimes have issues with maintaining this documentation from year to year. More and more, what we see is that it's not going to be an exercise where you just revisit it once every 3 years, but it will be more of an annual exercise where there will be more responsibility both on the client to maintain the information and for the advisor to also make sure that any updates in legislation are reflected in there. So in order to deal with that, we also have some nice little tools with a guide where you can find information on the particular countries, whether or not you have entities in those countries, and also the information that you would like to see, that you can decide for yourself what you want to see. So get rid of all the non-necessary information for you and only show what is required. So some people like to see the flags, other people would like to just see the names of the countries. So if we take some of, let's say, Denmark, for example, our neighbors in the north. Every year, yeah. So this allows you to keep track of also if, for example, the master file has been completed, local file, but also if you need to do a CBCR notification to get a link to the portal. And in this case, it should be of the Danish tax authorities. Don't know if we have any Danish people in the audience here. But these are just the little things that make it a little bit easier to find the right information. On top of that, we have some blocks in our tool as well with country information, so that helps in identifying what are the thresholds, what are the percentages, what are the penalties as well. So we have that available in the tool as well, and we can link that to each of the entities and the countries in the tool. So there we go. If if we look at other information that we like to put in and focusing on transaction profiles, there's a lot of duplication. If you have a lot of entities you need to cover, and sometimes you need to be a little bit more specific. So even in this case, you want to be flexible in how you approach your documentation. So switch things up and down if you don't like the order of your transaction. Add transactions if you think that you need to do that. So we basically are able to cover all the basics, but still adjust where you need to do that locally. One of the things that is more and more important is to make a good functional analysis as well, where you describe your functions, your risks and assets. And I think when we were touching upon the profit split as well, it's very important to know, okay, who is adding the value, who makes which contribution, and to be able to do that, what we've done is have some indicators. How important are some of the functions that you describe? And again, you can make sub-functions as well, so you can make it as crazy as possible, and allocate a sort of relative level of involvement here, and allow the tool to visualize that as well. So I don't know if any of you sometimes struggle with the massive information that you get from clients, and you need to make sense out of it. And I think, as one of the speakers remarked, if you do an interview, the person that you talk to always thinks they're more important than the other person or from another department. They always think that they are the most key contributors to the organization and adding the most value. And you can even have arguments saying, you know, we saw the document, but I think the information on the sales should be above the production function because it's more important, or the marketing function. So in order to step away from that a little bit is to have these kinds of descriptions and processes in place, where you can say, you know, everybody is very important and we are just going to describe how it is in the business, and then at the end we will see what the outcome is. So this is one of the things that helps you in that description, with a couple of standard functions, risks and assets, and you can elaborate as much as you want. And of course, you can choose your own methodology or multiple. So a good remark with the application of a profit split is sometimes to use a secondary. Switch your tested parties, and make sure that the description that you use will be in some of the other parts of the document. And also, if you want to get some information here, you can always find it in the tool. And what we've done as well is we have a massive site on the background running with a lot of information. If we sometimes have questions from clients or new clients, and we do a call, then the funny thing is that when we look in the help functionality, 99% of the information is already in the tool. And of course we cannot say, well, you should read, it's all in there. But there's always a tendency for people not to read everything, but think, okay, I see a problem and we need to fix this soon. So let's ask a question, and in a way spend a lot of time that you can solve with these things as well. So we always say, you know, there's a help function, please use it. And there's a lot of information. And what we also ask is, when we have users, to see if there's something missing, you know, add something there. So I'm curious, are there any things that you run into with your work, where you feel that a quick solution or having information available will really help you in being a little bit more efficient? So if there's things, you know, please let us know, raise your hand or shout. So if I go back to this whole section, one of the things that we also got in recent times was, it's always a difficult elephant in the room to address, but the cost of databases. There's been some consolidation as well with the ownership of the databases, and it's not always necessarily that an increase in the cost of your database will coincide with an increase of the quality of the data, or make it timely available and make it a little bit user friendly. And some companies were saying, well, can't you make a nice benchmarking tool as well? And initially we were thinking, okay, how do we do that? Where do we get the data from? And then you think, okay, if we run into any issue with the licensing of an existing database, the costs are insane, especially if you license that to an advisory firm that does a lot of benchmarking, but most of the benchmarks are the same. So there's duplication there, and you still pay this exorbitant fee. So for us, this was a reason to introduce a benchmarking database as well, where we collect data from the same source, basically Chamber of Commerce, SEC filings, those type of things, and integrate that in the tool without adjusting any of the data as well. So we can do all kinds of analysis here, where you can have your information on the countries that you want to document, maybe the years for which you want to document, and any financial information that you want to include, where you will be able to quickly see the companies that have been selected. So we only want to put in companies that actually have financials. A lot of time is wasted by getting an extract of data, then going through it only to discover that either you cannot find information on the internet, or the company has insufficient financial information, so you need to reject it. So we try to eliminate that step as well. But at the same time, be transparent in the information that is available, be that financial information over the years, or finding a website of a company, and being able to do that quickly as well. So this is one of the things that, even in our work, we thought, if we create a report, why are we wasting so much time on this benchmarking? And if you have your benchmark of head office expenses, you can use it for one client, you can use it for a lot of other clients as well. So that avoids a lot of duplication. And of course, before you create your report, to be able to see, okay, what is the outcome here? Does it make sense? What if I'm not fully happy with the result, but I just want to make some changes in the financial years, and say, will it have an impact if I change a year and add some additional data? And will that help, for example, the client, instead of dealing with the question, why are you just outside of the interquarter range, to quickly see, are there things that we can do to solve them? Because we're not in an exact science. And I think that's one of the benefits. But being able to see if there's like a solution that can be helping in a quicker way, these are like the little things that can be of benefit as well. And of course, to be able to say, I want to download a little report, or I want to integrate this information in a big local file. So this is one thing that helps there, and where you can see your little Excel with your benchmark results. So your search strategy, elimination matrix, financial data. We all know this tedious type of documentation that we need to add, but also to add maybe a little write-up for countries where you don't need to do like a full document, and basically see your local file with your results and your steps that you sort of check the boxes and whatever you want to include there. So this is just one of the additional add-ons that we've done. Looking at the actual creation of a full local file, where you integrate everything, it's nice to have like a little management with the traffic light where you can see what is the status. If you share this with other colleagues that are, or a client for that matter, that have to add information either on the legal entity, maybe on the structure and the FTEs, or maybe on the actual transactions themselves, that it's possible to get this input. But at the same time, if you have another colleague who works with the same data and only needs to provide input maybe from a CBCR perspective, that we also have a little type of mini survey where the only thing they need to look at is, okay, what is relevant for my CBCR to input legal entity information? Is it correct? Country by country reporting, maybe some activities, and then have somebody else figure out what the comments should be. And this can be used for the collection of information and let somebody else decide what to do with it.
Yeah, and if I may add here, this morning I heard the panel talking about the profit split and that it's a huge burden to do the interviews among the company for retrieving the data on creating a nice profit split result. This is a perfect example where we could integrate it in the tool. So if you have ideas on if we can automate the process for creating this profit split thing, then please let me know, because we are very happy to think along and to see where we can automate things and make your life more easy. And it's, for example, this survey could be a perfect example of where we can integrate such features. So please let me know if you have ideas on this.
Yes, and for people who don't like to make those boxes and draw everything, with a click of a button, you can visualize your transactions with the various entities where you've collected the financial information. So again, going from describing things in Word and spending a lot of time in visualizing, and then discovering at the end, oh, I forgot to add a line with another transaction with the risk of not being complete. These are the little functionalities that can help there as well, and create this kind of nice output with nicer pictures than I could ever make. I think one of the things that I like to do here is not only show you a little bit of what the tool can do, but also to pick your brain maybe a little bit and to see what are the things that you are running in the most, or things that you have during the creation of a report, or any interaction where you say, well, this is maybe not my favorite part, or it's very repetitive and it wastes a lot of my time that I can spend on other things. Also looking at the fact that, you know, resources are always limited. There's only so many TP experts, and there's only so many clients you can serve. And if you can make it a little bit more efficient, then that means you can also maybe do work for maybe more clients, and increase the revenue as well. Or do it another way. Yes.
I had a question. I saw that on the benchmarking tab you had numerous transactions that you used for benchmarking.
Yes.
What's the coverage on those companies and the
Global.
you have a number?
I have some numbers. Ari, maybe you know it from the top of your head. I can have a look here. So in the demo, so this is only for the comparable companies. We have a core data set of about 15,000.
These are global public and private companies.
Yes. Yeah. So we can even change the jurisdiction and see how many comparables you have in a particular area, maybe even Andorra. It's probably not of comparables there. But it's possible to make these type of updates and select the country. So now I selected a couple more countries. So you could see that we went from about 15,000 to a little over 26,000. So depending on your needs, if you need to do a local search or a global search, you can modify this. And even when you need to tailor it for local purposes, you take the full set. When you have your specific individual country where locally they require you to first look at your local comparables, you just uncheck everything and only select your country box, then you basically have the same data but at a different, more zoomed in view. So you can really, yes, Jimmy.
Providing more data.
Yes, sometimes we see this more in Eastern Europe as well. There were some tax authorities there that were a little bit persistent in saying, well, we as tax authorities have bought this database. So in order for us to compare the data from your set, you should use the same data set. And of course, if you look also at the OECD guidelines, you cannot force the taxpayer to choose your database. And there have been, in some countries, court cases even going up to a Supreme Court, where they were indeed saying, well, tax authorities, really nice that you didn't buy the bigger database or the smaller database. But if the taxpayer is using a different database where the information can be verified as well, maybe by visiting a Chamber of Commerce website, then that is sufficient. So we had discussions, but never up to a level that the results were not accepted. And of course, you can have situations where a bigger database can provide maybe some client-specific results that are better, that you have slightly more comparables as well. So then I would sometimes recommend maybe using a different database that can make a difference as well. And I think we see the same thing with financial analysis as well, like what credit rating are you using? And there can be differences as well.
For comparables, the source of information you're using and the source of information in order to documentate the comparables.
Yes.
Because tax authority sometimes ask you which is the source of the information.
Yes.
The main source of information. In this solution, we don't have a specific, let's say, record of the where the information came from.
We add a little sentence saying, the information comes from Chamber of Commerce or SEC filings, depending on the type of search that you do as well. So it's different for these comparable companies than if you do an analysis for interest rate. So we make that clear. And in the end, I think all of the database providing companies, they all use the same source, which comes ultimately from the companies.
So that is my point. It will be useful. It will be easier. It will as a user, it will give you a sense of this is the source. I'm gonna look for that source, because many times tax authority asks you for the information of 2-3 years ago, and you don't have it in the top of your mind. So you go, okay, let me. If the tool had this is something as a user, I think this will be a great advance for.
Yeah, we currently do have that trail in the back end of the tool. So it is all in the database running on the servers on the back end. So for us, it's like trackable, but we do not present it in these screens. So it's a very good suggestion indeed to add this to the front end. Yeah, definitely. Thank you for that.
And you always add it in the end document where you have a line. This is the database that we're using, and this is the source. Usually, if you do Amadeus or Orbis, you just mentioned we're using Orbis. We're using this update, but you're not specifying Orbis gets its information from Chamber of Commerce, or those type of things.
Yeah, and tax authority are asking for that information. They are not satisfied with what database you're using, but I want to know the source. I want to see the source sometimes.
Oh,
But
absolutely,
it's-
absolutely. And I know of one case in Italy where the database provider modified slightly the financials.
It happens, yeah.
With good reason sometimes. And then in an audit, the tax inspector said in front of court, look, these numbers do not match with what is in the Chamber of Commerce. So this is for us a reason to exclude the entire benchmark. And then you don't go into discussion about individual comparables, but you eliminate everything. So this is something that we don't do. So we don't modify any financials or make any adjustments to what you see in the tool. What you see is the same as what you get as well from a Chamber of Commerce filing.
That is one of the reasons, because sometimes company update their financial, and sometimes there are some requirements that need to adjust information, and in that case, it's valuable to have that source, that main source that was used in a particular moment. That's
absolutely correct. Absolutely correct.
Can I just correct you? Orbis and Amadeus does recommend the source. It would give you the source of it.
So they always say that this comes from this Chamber of Commerce. Okay. Yeah. Yeah, I think it depends on what you select and what you have in your output as well. Yeah. Yes, correct. Yes, yeah. So we have a lot of those links in here as well. Yeah. And any other things from the audience to pick our brains? Yes. Jose, thank you.
Okay. Talking about the benchmark tools, I saw that you have an option for intermediary financial transactions.
Yes, that's an option as well.
Yeah, can you? I don't know. Maybe we don't have time, or it's not planned for the session today. But I mean, just curious about what type of methodology are the tool using for setting up or for estimating the return of these entities.
Yeah, basically what we're looking here is more of an indicator, for example, of a margin that you would like to have based on, for example, a credit rating either by, for example, Moody's or S&P rating that you have available, information on the tranche. So you can see for the comparable companies analysis, there is significantly less variables and options that you can use than for interest rate analysis or intermediary financing analysis. So all these little blocks that you see here, you can tweak and adjust and see if there's anything available in the public data to create the outcome. And of course, part of how you approach these type of transactions are sometimes very specific per advisory company. So they all have their own language, their own approaches. Even within multinationals, they sometimes have a massive internal almost cup system to identify how they come to a certain margin. And in the documentation that we can create and set up, we can customize that. So the output that you would download can be very much be tailored to what your approach is or the different approaches that you choose for different clients. Like you can choose, are we going to use Standard & Poor's now, or do we get better results by using a Moody's database, for example, and Moody's numbers? So we try to be as flexible as we can with the options.
Also, similar to the question from Jose, in the benchmarking tool, I saw that you were also including royalty analysis.
Yes.
Does that tool provide access to third-party agreements, and does that allow for the download of the agreements, or how does that benchmarking tool work?
Excellent question. And here we ran into a license issue. So we can provide the results here of the outcome of the royalty, but if we want to download the individual agreements, we need to pay a little fee to the royalty database provider. So if you want to do a very quick scan or do a sanity check, this is perfect to use. If you then want the underlying agreement, so if you're happy with the result and you want to substantiate this, then there's a small fee that we need to pay to third party to get those agreements. So we have them available, but due to a license issue, it's not possible for this to download.
And do you have access to at least a summary or an overview of the agreements?
Yes.
Okay.
Yeah, there will be like in Excel, this type of agreement with these details, but not the underlying agreement information.
Okay,
and for that we need to sort of switch on the function and say, okay, are you happy? Do you want to have those agreements separately? And we can provide them.
Okay, thank you. And one last question regarding the modules of the tool or the database.
Yes.
Can you provide the solution excluding the benchmarking tools?
Of course. Yeah. It's basically like ordering a pizza.
Okay.
So the only thing that is mandatory is your pizza bottom. You can choose maybe, do you want to have it vegan with beets or do you want it with dough? And for the rest, you decide what toppings you want on your pizza and what you like to have. So there are many advisory firms that don't have multinationals with over 750 million in turnover that require CBCR. So yeah, why would they take a CBCR solution? And if you don't need to translate the documents that you have. So if I take a German company and I have a report here, and I want to translate that in German, maybe another language, but we can do German. So then you don't need it. But if you create documentation for many different countries, and at least you need to have somebody understanding the local language or accommodate a tax inspector, then it can be very useful to have this type of functionality. As you can see, the translation always takes the most amount of time. But this is one of the key things that will really help in making quick adjustments. Or if you do this for Poland as well, Spain as well, and we see differences there between the Spanish and the Latin American Spanish as well. So there are some options there. But even if you do it in Japanese, it's also possible.
Great, thank you.
Yes. Yes.
Made from the transfer pricing perspective, because sometimes the literal translation,
yes,
it's not useful.
And
it doesn't work.
Yes, and this is where we go into a very hip and modern word, artificial intelligence. Okay. So it's sometimes overrated and overused. The translation tool that we are using is not Google Translate, but it's a German company. So Germans like to export their knowledge, of course, like I heard before today. And it's sort of self-learning. So over time, it's improving. And if we look at some of the first versions of this translation module we were using, we thought, no, we cannot connect this to our tool or show it to the clients because it's not there. I'm not going to say that's there for 100%. Okay. But it's very, very, very good.
It's still a computer translating. Yes. So there's always it's not a human or translation service that you hire. So there's always like little things which are off. Yeah. But the service we are using is called DeepL. It's a third-party service from Germany. It's not Google because we don't want to send our information to Google. It's
privacy, GDPR,
privacy-related issues. Yeah. So DeepL is not storing any information on their servers or using it for other clients or to improve their services. So it's a very good service, but still it's a robot doing it and not a human. So
and to give maybe one practical example, with an audit in Italy, we got good feedback from multiple clients on the quality of the translation, both from the local advisor as from the Italian tax authorities. So this was like a good test, are we confident enough to release this? And of course, there's lots of transfer pricing jargon, but the tool will learn from that as well. So over time, it will only get better.
And is it also possible to manual adjust the template?
Yes.
Yeah, so we have different options there. It's maybe a bit too much to go into that detail, but we have options to export to Word, make modifications and re-upload in the tool, or make changes to specific sections in the tool, also for future usage. So there's a number of options we have in the tool to accommodate that.
Yeah, and download Word, PDF, download your entire package, see what has been downloaded in the past. So you have an audit trail. So there's lots of flexibility there.
How about uploading? How about uploading reports? Like, for example, if we are we have evaluation reports provided by the client that is necessary in order to justify the arm's length value of an intercompany transaction, so we don't have to prepare it, for example, it's easy, I guess, to upload it and to embed it into the report that we're preparing.
Absolutely. We have a section here called upload attachments. Now we predefined those attachments as being agreements, maybe local org charts or statutory financial accounts. But if you're looking at a valuation report, for example, or a different type of documentation, maybe business restructuring related or whatever, you would be able to upload your agreement in PDF or Word and add it, maybe see preview here. Specify some things, when was it made, by whom, and to have some metadata connected to it. But yes, this is possible. And you can attach this also to the local file. And then when you finally have your downloaded package, that your entire package not only contains the file that you're creating, but also the attachments that go with it, that you upload it, be that your benchmark Excel, your master file, or any other type of documentation that you attach, like agreement or evaluation report. I hope that answers your question. Yes.
Thank you. Earlier, I saw on the screen the country.
Yes.
The countries. So I saw you've got Africa. Which countries do you have under Africa? Can you go back to that screen and expand on Africa, please?
Tools.
Because it's very difficult to get comparables for Africa.
Oh,
So
definitely. Or you mean the benchmarking?
yes, on the benchmarking. Yeah.
Okay, there we go. Because we have a lot of African countries here.
Yeah.
So
I'm not. Do we have benchmarking data on Africa currently?
I think we have some, but again, it's limited for this one. So I know there are not too many loans there, but let me have a look what we have in here. Yes, edit. And this is only for this type of transaction. So there's for this type of transaction, there's not a lot of data. But if you want, I can check that specifically for you and to see what data do we have specifically for Africa and in what type of transactions it could be useful.
That would be great.
Yes.
Thank you.
So happy to do that.
Yeah.
Yes.
Yeah, and it could be a very good suggestion as well, to let us know what you need, because we of course we need to purchase this data from the third party, the provider, which accommodates with this information. So if you have like input on that, then we are very open to add it to the tool as well.
Sure. Okay.
Yeah.
Thank you.
Yeah, and I think there are sometimes, like in Eastern European countries, they like to see that you first try and find local data. And it's not sufficient to say, well, our database does not have this, because they will say, well, then, yes. So, good point. Yes, absolutely. Yes. Anything else from the audience? Yes.
Yearly basis.
Yes.
How does the update of the information works? We have to upload everything again?
We use migration.
Okay.
We have a migration tool and a migration assistant. So this process will help with migrating the relevant information from one year to the other, where you can even decide, we need to add another year. Our tool is like year-based. You can decide your legal entities that you want to upload. So here you have your entities that you want to move to the next year. And let's say you have a multinational that eliminated all their Russian business. So then you migrate everything except the Russian company, for example. So you don't need to copy, paste, and type everything all over again. And this will save some time. With multinational clients, what we have seen is that the saving of time over a 3-year period was about 50%, with an increase in the quality of the output as well, and reducing the exposure risk.
Yeah, so basically what we do when the tool is set up, it's the first year is kind of takes a lot of time because you need to learn how to use the tool, put all the data in. But in the subsequent years, you can roll forward the data, the relevant data, and only
or backward,
yeah, and only insert the financials for that specific years, FTEs that change, maybe change in business. So it's only really small changes you need to make. So with one click of the button, you can create your transfer pricing documentation for the subsequent years.
And any other things that you would like to know or see? Or
maybe you can summarize the updates that you are planning to introduce in the tool during this year, or?
Yeah, absolutely. Yeah, we do have a roadmap. We also, on the top right of the tool, there's an orange bell, which you can click. It shows all latest releases, and if you're interested, I can also share later with you some more information on the tool and on the releases. So we do monthly updates with the tool, with the development of it. And for the roadmap, it's also defined for the upcoming year. So we're currently investigating in Pillar 2, for example, investigating in public CBCR, which is going to be used in a few in 2024. So yeah, there's a number of bigger topics that we are covering, and also smaller updates in the tool. So I hope that answers your question.
Yeah, of course. Thank you.
So now Arjen is going to sing.
So now there's one last thing I would like to ask. So if you experience like IT related issues, or if you think there are things that you can automate within your practice, then in this afternoon or during lunch or tomorrow, please let me or Steve know, and bring up your ideas and topics. So we are very open to receive your input and to think along, because like I said, the tool is built with the input of our clients, and that's what it made a mature and useful tool for our clients. So if you have ideas, we're very happy to cooperate, to think about it, and to integrate and build it to make your life easier, and yeah, to add value. So yeah, please let us know.
Thank you, Steve. Thank you, Arjen.
Thank you,
for the
audience.
friends of and the audience, obviously. We'll still have 5 more minutes until we go to lunch. There's any final remarks, recommendations, or comments that you would like to give to our friends? To not. Thank you very much for your time and the presentation. Thank you, the audience. And for final remarks, today is Women International Day. So our incredible staff of PPI will give you a gift for that matter. And at 12:30, we will have the lunch break. We will come again until 1:30 p.m. to continue with the next panel of discussion. The next panel will be really interesting with international organizations. So please let's be here in time, and let's have lunch. Thank you very much. Thanks so much. Thank you so much. Thank you. much, Norman.
Thank you.
The next participant is Marcio. Sorry. Okay. Sorry. Marcio Ferreira Verdi, who is the Executive Secretary at SIAD. He's an economist and retired tax auditor from the Federal Revenue Service of Brazil. Mr. Verdi is the Executive Secretary of the Inter-American Center of Tax Administration, SIAD, and currently the President of the Network of Tax Organizations, NTO. He has specialized in international economics at the University of Brasilia. He has a postgraduate degree in theory and implementation of a modern economy from the George Washington University, and from the George Washington University from the Institute of Business Affairs and Public Management of Brazil, Washington. He also is an expert in development and evaluation of public service concession projects from the State University of New York, and also an expert in analysis and negotiation of build, own, operate, and build, operate, transfer projects, alternative strategies for infrastructure development of the American University of Washington, D.C.
Don't forget, and I love golf and soccer.
Nice. Thank you very much. And we would like that Gabriela Capristano, please join us. Thank you very much. Gabriela is an analyst and in the transfer pricing unit at the OECD since 2021 and is involved in various transfer pricing projects, including on issues related to global mobility of workers. Before joining the OECD, Gabriela has worked for the United Nations. Gabriela holds a degree in law from the Catholic University of Pernambuco, Brazil, an advanced LLM in international tax from Leiden University, the Netherlands, and is currently a PhD candidate in international tax and transfer pricing at WU Austria. Thank you very much. Right now, we will start as the previous panel of discussion, having a presentation for 10 minutes for each of our participants. So, Norman, when you're ready.
Okay, so I hope everyone can hear me. I've already lost my voice before speaking on the panel, but I hope it's okay. Yeah, first of all, thank you very much for the invitation and giving a couple of observations from my perspective. I think this panel will be on the first hand, you think it's maybe the least relevant for your day-to-day work because we are talking about a little bit the policy, the global policy environment. But don't worry, whatever is discussed within these international organizations, it will trickle down at a certain point. It will come to you and your clients. I want to give you, in my 10 minutes, a little bit of background about the EBRD, what we are doing and how that is relevant to transfer pricing, and then based on the headlines of this panel, talk a little bit about the tax policy work, about the digitalization, what has happened there in the last couple of years, and that the keyword is, global tax reform, global minimum tax, pillar 1, pillar 2, but yeah, just high level. So as I was introduced, I'm working at the European Bank for Reconstruction and Development. It's a development bank. I'm based in London. So you might think about, okay, how does that go along Europe and London? It doesn't. So there is no love affair between the UK and Europe anymore. But we are not a European institution. So we are really just a development bank owned by around 70 countries, the majority European countries. And that means we are financing private clients in our countries of operations, which is mainly Eastern Europe, Middle East, Central Asia, Northern Africa. So we are financing them for a transition into a more sustainable, more greener, more inclusive future or economy. So we are really like a development bank, like the World Bank, the Inter-American Development Bank, the Asian Development Bank. So it's all a little bit split regionally. And now you wonder probably, well, how is that related to transfer pricing? Because we are giving money out like a commercial bank. We look at our private clients. And in the last couple of years, there was really a push from our directors, from our governing bodies, that we should only give money out if our clients are responsible taxpayers. So we want to be a responsible investor, making sure that our clients, our private clients, which could also be your clients, are using the money in a responsible tax way. And that means that all of these development banks, the EBRD included, have set up a tax due diligence on their clients in the last couple of years, which includes transfer pricing. So we really look, okay, there is, I don't know, a wind park or a solar park in Egypt. There is this local SPV, the local entity. Then we look up the controlling ownership chain to the ultimate beneficial owner. And we really look, okay, does that make sense from a tax perspective? Are the jurisdictions involved? Does that make sense? Is there a commercial reason? Are the jurisdictions involved? Are they participating in the exchange of information? Is the transfer pricing okay? Is the transfer pricing documentation there? Are there jurisdictions interposed for treaty shopping, for example? So it's really like a broad tax due diligence. And I would say these multilateral development banks like us, we are taking the OECD G20 standards, which have been evolved or agreed, in particular the BEPS standards, and we are applying them in practice in our projects. And there's always the fine line in our due diligence that the clients say, well, but it's all legally okay. So why are you not happy? And for us and the other banks, the how do you say, the watershed moment is, of course, it needs to be legally accepted, but there needs to be a business reason and not only a tax reason. So tax planning is allowed, transfer pricing planning is allowed, but there needs to be, in addition, or in the first place, ideally, like a business or commercial reason. So for example, if in the structure is Malta, for example, then there needs to be like a business reason why there is Malta, and not only that the company benefits from the notional interest deduction in Malta, for example. And yeah, I think that's the work I am doing, or all the multilateral development banks are doing. And I think that's coming out of all the global tax policy developments in the last couple of years, that there was more of a focus of fighting tax avoidance, fighting tax evasions, all the leaks, Panama Papers, Pandora Papers, Paradise Papers, that it's really a focus, well, for us, because we use public money, to avoid this reputational damage and making sure that our clients are responsible taxpayers. Okay, so that was the first part. Any questions so far? Or I think, yeah, oh, please.
How do you proceed then to assess the... Thanks, everyone. Thanks for that. How do you proceed then to assess the arm's length nature of those transactions, or the normality, so to say, of the operations?
Well, the bare minimum is that we require a transfer pricing documentation that someone else than the client has testified that it's arm's length. But as you know, everyone knows, you get a report for almost every transaction, right? So then it's a little bit of, okay, so that's the bare minimum. But if it's really very aggressive, and for example, there are a lot of base eroding payments so that there's no effective tax left, that's also another risk indicator. But basically, we rely on the transfer pricing documentation. Okay. Then a little bit the broader picture, also because as Gabriela works now at the OECD, I worked before Gabriela 5 years at the OECD and was involved in the discussions there. And so the headline is transfer pricing and changes through the digitalization, or the digitalized economy. And I just want to give a little bit of a brief overview what has been discussed, what is under discussion, and how it is implementing our countries of operations, which are all developing countries. What will happen with transfer pricing in the future? So when I started at the OECD, well, or briefly after that, I was dragged into the Pillar 1 project team. And it all started, it was basically a leftover from BEPS Action 1, where the countries couldn't agree on anything. But the countries were unhappy with the current transfer pricing system, with the current profit allocation within multinational enterprises, because through digital means, you can serve customers or users in a country without being present there. You don't need a PE, you don't need a subsidiary. And certain countries, or many countries, didn't like that. And the response was, well, let's introduce them, if we cannot tax them because there's no physical presence, then we introduce a digital service tax and just grab a certain percentage of the revenue. And France, for example, over here is a prime example. They were unhappy that they couldn't really tax Google because Google was like outside of France, but they introduced a digital service tax. So that was the whole beginning, this dissatisfaction of the countries that the existing transfer pricing allocation or transfer pricing rules or allocations weren't fit for purpose through the digitalization, and that it needed to be changed. And another, and the indicators were really the mushrooming of digital service taxes all over the world, right? They popped up, and I think are still popping up like crazy. But you also see it in your in your day-to-day work. Transfer pricing is the topic which will be picked up first from the tax auditor, because we heard earlier this morning, it's not an exact science, it's not black, it's not white. So that means the tax auditor can always argue, oh, well, no, it's not correct. So there are a lot of instability in the system because of the dissatisfaction of the jurisdiction with the transfer pricing. So what has been discussed or what has been agreed and is still under agreement and implementation is the so-called two-pillar solution. The first one, the pillar 1, is really a reallocation of the taxing rights from wherever the profit is right now to the market jurisdictions where the users and the consumers are, because the premise was, okay, the market doesn't get enough taxing right. And that's the pillar 1. That's the basic idea, which is very, very simple. And it's the so-called amount A, the reallocation of taxing rights. So you imagine a multinational corporation which has the residual profit in one country. Then in this country, the profit will be reduced and will be then allocated to the market jurisdictions. So it's technically very, very difficult to do. There's a lot of building blocks, technicalities to work out. In particular, because it should not lead to double taxation, it should just lead to a reallocation. And I think this pillar 1 has been agreed politically in 2021. And the OECD, what I'm hearing is they're still saying, okay, we can make it work, and it will be agreed through a multilateral convention by the summer this year. So that's the reallocation. There's another part which you're probably more aware of, is the amount B. So if you have a physical distribution activity in one country, that should be simplified with like a standard return. For certain activities, there should be a standard return. So that's also part of Pillar 1 and should also be finally agreed this summer. But that means implementation will follow as of next year or even later. And I'm conscious of time.
You still have 4 minutes.
Okay. Perfect. Okay, perfect. So that was pillar 1, which is currently proposed for really just the largest, most profitable companies. The threshold is 20 billion global revenue. But again, you can think about it, I don't have any client that large because that is Procter & Gamble, that is Unilever. But don't worry, it will come down to your clients too, because it's very easy to lower thresholds. If it's working, the countries can easily lower these revenue thresholds. Okay, so that's pillar one. Pillar two was like part of the package, but it has nothing to do with the digital economy. It's the introduction of the global minimum tax, which was agreed to be 15% effective tax. And the aim was like to put a floor to tax competition. Yeah, a floor to tax competition, 15% not nominal, but effective, so that a multinational company should pay 15% on a global scale. But that doesn't mean it pays 15% in every country, it's just on average. And there, now from my work at the Development Bank, developing countries have to be very careful because how it's working technically, it's with the so-called income inclusion rule, which is like a CFC rule. That means the parent jurisdictions taxes, applies a top-up tax on profits, on low tax profits in other jurisdictions. That means the headquarter companies, like in Europe or in the US, will originally benefit from it, unless the developing countries, they introduce a so-called domestic minimum tax or qualified domestic minimum tax, what the OECD and everyone is also now recommending, so that which would lead basically to the fact that the multinational would pay 15% in every country. And once it pays 15% in, let's say, Kazakhstan, Uzbekistan, or Egypt, so that are the countries where my bank is active, then there is nothing else to be done. Once there is effective 15% of taxation in the country, then there is no top-up tax. Yeah, I think that are the very high level, this discussion of the global tax policy developments, and I'm sure Gabriela can add a little bit to it maybe later or maybe not. But that has been discussed in the last couple of years. The global minimum tax, countries are preparing to implement it. They will start implementing it, the EU, as of next year. And it can be implemented just through domestic measures. That means if Germany implements it, then it can levy a top-up tax all around the world. So there is no multilateral instrument needed. And yeah, pillar one, I'm not quite sure if and how it comes, but yeah, that are the current developments, which again, maybe they've seem far away right now, but they will come sooner or later. Thank you.
Thank you, Norman. Then again, Norman, International Tax Advisor at the European Bank of Reconstruction and Development. Thank you very much. Let's continue with Gabriela. So you can start.
Okay. Okay, it's working. I've heard before that there were some issues with the microphone that I should speak louder. So please just let me know if at some point you stop hearing me. So I'm Gabriela. I work at the OECD now. I'm originally from Brazil, but I started the OECD just after Norman left, so we just missed each other. So maybe I will give a brief update on the work on the pillars, but maybe just a little bit later at the time of the questions, or if time permits, I will also speak now at the end of my intervention. So I've been asked to talk about post-COVID tax model and the challenges with digitalization that came with a post-COVID. So it's no news to anyone that the COVID-19 pandemic caused a huge disruption in people's lives and business, and that there were a majority of business incurred unprecedented losses. But we should not forget that some of those business also had gains with the pandemic. And those business were either the digital business that we all recognized, like Zoom. There was a boom on Zoom, but also the more traditional business, but that are highly digitalized. And either because they were already highly digitalized before the pandemic, or because they were so quick in adapting themselves to the new environment that they were able to either have gains from the pandemic, or to reduce the negative impacts of the pandemic in their business. So they incurred less losses. So there is an undeniable relationship between the COVID-19 pandemic and digitalization. We can all agree on that. We can all see that. But I would like to make a distinction between this relationship of how our lives become more digitalized, how it's easier now for us to conceive to have conferences online, although it's very nice to be in person again. This is actually the first event post-COVID that I am in person. But it's much more normal for us now to conceive a world that it's more digital. However, this is different from the work on the pillars that Norman just spoke. As Norman said, that he started working on the pillars in 2018, so before the pandemic. So I think it's important to make this distinction, because I want to say that the COVID-19 pandemic did not have a significant impact on the work on the pillars. So the work on the pillars was already there, as Norman, correctly and very clearly put out the reasons why the work on the pillars started. It was a dissatisfaction from the countries on the big digital companies like Google, that they saw there was something happening in the market, but they couldn't tax that because there was no physical presence, and therefore they couldn't use transfer pricing. They couldn't grab those companies. So that started before the pandemic. And of course, during the pandemic, we had to change the way that we worked. Everything became digital. I have colleagues that were working for the OECD for 2 years and a half, and they didn't go to the office for all that period. So yeah, the delegates started also having negotiations online, and of course in the beginning it's difficult, as it was for everybody, but that was quickly adaptable, and the work on the pillars continued, and it was not materially affected by the pandemic. What happened with transfer pricing in the OECD on the pandemic was that we issued a guidance on the transfer pricing implications of the COVID-19 pandemic. That guidance was issued some time ago in December 2020. And there are a few things that I think it's worth to highlight about that guidance. The first thing is that it is an inclusive framework guidance, meaning that all the members, all the jurisdictions that are members of the inclusive framework, that now we have over 140 inclusive framework members, they have agreed on that guidance. So that's one important point, that it's different from the guidance, for example, on the tax treaty guidance of the COVID pandemic. That was a secretariat guidance. That means that it was a work only from the secretariat. We didn't have, it's not to say that our delegates do not agree with that, but we didn't have a formal approval by the delegates and by the inclusive framework members to that tax treaty guidance, but to the transfer pricing guidance we did. So that is inclusive framework guidance. The other point I want to make is that that guidance follows the transfer pricing guidelines. So our delegates saw no need to go beyond the guidelines, but just to provide further clarifications and further guidance on how the principles and the guidance in the transfer pricing guidelines apply for the most pressing issues that they saw coming from the pandemic. And then those most pressing issues was like divided in 4 parts. The first part was the comparability analysis. Then we have a chapter there in that guidance as well on the allocation of losses. government assistance and APAs. On comparability analysis, maybe I just allude to the point of the timing issues, availability of data, for the years affected by COVID. Then on the allocation of losses, there was a big question on could limited risk entities incur losses. Government assistance, I will talk a little bit later because we received a question on that. And then on APAs, it was, a big question of what should they do with APAs. One thing is that we don't plan to update that guidance now that some years have passed. We think that guidance is still, fit for purpose. Our delegates do not tell us that they've been having a lot of issues with that. It may be a question of time because by the time they start auditing the years that were affected by COVID, that may be some years ahead depending on the country. But what we do plan now looking to the future is that there are some trends that either appeared with COVID or were enhanced by COVID. And the most important that we see now is the remote working. So on remote working, if you would look into the future, that's the point that I wanted to discuss with you and hear your views on that as well, because a lot of business have been coming to us and telling us that they are having a lot of issues now with what they call the war for talent. And that is because flexibility on remote working is being crucial for them to recruit and to retain people. So they've been telling us, well, they want to give the employees more flexibility, but they are very unclear of the rules. They are afraid they're going to create a PE, what sorts of other issues they might have, and if they do create a PE, or how much profit should they attribute to that PE. So it has been approved already in our program of work. So for sure, we are going to work on global mobility issues. Not right now because we are still quite busy with the work on the pillars, but this is coming. And right now we are at the scoping exercise, meaning that it would be very valuable for us to hear from you as well. What sort of issues you are facing or you see with global mobility. And this project on the Z-scoping issues, we've been thinking of a narrow scope or a broader scope, depending how ambitious we and our delegates wants to be. On international tax and the transfer pricing, we have the option to address the lower hanging fruit. That's the permanent establishment issues. And there was a tax treaty guidance of COVID that I mentioned, the Secretariat guidance, but that's only for the COVID period that the Secretariat said, well, home office PE home office should not create a PE. But now that this is more long term, how should we think about it? What should be our approach? So all those kind of issues, and then if there is a PE, how much profit should just one person working in another country in his home office or her home office create or attract? So yeah, what if there are, instead of one person in this other country, there is like 10 people working from that country? From where do we draw that threshold and how much profit we attribute? And there is the more broad issue, maybe in the last 10 seconds, that if we want to be more ambitious, we address not only the PE issues, but also a discussion on Chapter 1 and the allocation of risks.
Thank you. Amazing. Gabriela Capristano, analyst of the transfer pricing unit of the OECD. Don't worry, Gabriela, at the end, we will have plenty more time, so don't worry about it. So now let's continue with Marcio Ferreira Verdi, the Executive Secretary at SIAD.
Thank you. Actually, thanks for the invitation. I'm very happy to be here. It's a joy to be here. It's, how could I say, but I started working with transfer pricing in 1994, when that time we were studying in order to implement, and we approved a Brazilian legislation on transfer pricing. I think we all know that in Brazil we have specific methods with fixed margin. I was part of the team when we prepared the law. And so I started studying, that time trying to understand transfer pricing. After 30 years, I didn't understand. So I think I know less about transfer pricing today than 30 years ago. But this is amazing. But you know why? Because transfer pricing is an unfair, life is unfair, the world is unfair, but transfer pricing is an unfair field. Of course it is. Because if for you guys, it's a great opportunity. You do your job. You will help companies or countries, but you is part of your service. For a tax administrator, is a nightmare. A nightmare. It's a huge problem. But do you know why it's a nightmare? Because when you have one tax official that understands and knows how to apply a method, they go to the private sector. The private sector hire these employees. So I of course, I'm not here to mention countries, but I know many countries. We are training the third or the fourth team on transfer pricing. Each 4 years, we have new guys to learn transfer pricing. So it's a nightmare. But do you think that in 80% of the countries of the world, they have teams to understand what we saw during this morning? Of course not.
Sorry, there's people in the back that can
The
hear you well.
OECD, they are doing a great job. They are working hard with the tax inspector without border. We have to applaud, of course. I was with my dear friend Pascal Moncherry-Ami in South Africa when they decided to create the tax inspector program. But when you send guys to Senegal and you prepare tax auditing, but believe me, when you have 2 or 3 guys from the Senegal tax administration, there is a huge probability that these guys will find a better job in the private sector. What I mean is, if in your country, if in any country, if we don't have public careers, if we don't have public servants, we, from the government, we are always restarting. It's amazing, but it's impossible to have a team ready. Because you are supporting the companies. So the companies are multinational, rich companies, big companies, and they have the support of your teams. And now change your side. Go assume as a commissioner of a small country of Central America and Caribbean, and you have one guy that with an average English trying to understand the methodology. Is a nightmare. It's a nightmare. And in my personal opinion, it's not a seared opinion, things are becoming more complex every day. We cannot simplify. We don't know how to simplify. We are always putting more complexity in the system. And this is good, maybe for tax consultant, of course, nothing again. But looking for a developing country in the world, this is not, it's not going to work. It's not going to work, my friend. How many tax auditors developing countries do in a year? In Sudan, you can say in Sudan they don't have many problems. They have in the mineral sector or in other countries or in Brazil. So in Brazil, we don't have, maybe they will change the Brazilian legislation. And maybe this will be very good, maybe, for looking for one side. From the other side, it will be a disaster. Brazil collect 10 times more than Mexico on transfer price adjustment, 10 times more. In Mexico, at SAT, they have more than 150 guys working only with transfer pricing. In Brazil, they don't have more than 5, because we don't need. There is fixed margin. You need an Excel. With 5 guys in Brazil, we collect 10 times more than a country like Mexico, and 40 times more than in Argentina. Because in Brazil, we have methods that are easier to implement. And we have safe harbors. So, but no, we are working in order to, every day, things are becoming more complex. And this is part of the game. Not since, again, but we need to have careers. This is the point. We need to have professional auditors. I started working for the Brazilian government in 1977 as a publical server, approved in a publical contest. And so I had one career. I am retired. I have more than 10, I'm 66. I have more than 6 years retired, 18 years working for SEAT. But the reality, even big countries, in many countries of the world, big countries in terms of geography, they don't have a auditor or official careers, the public sector. What we do at SEAT, we try to reduce this gap. This is our goal. We work, our program 1, international cooperation, program 2, tech studies. We have many programs, etc., project, more than 60 projects. But if we squeeze what we do, we try to reduce the huge lag that we have in terms of knowledge. And this only with training is very difficult to create a good team on international taxation. You see Pillar 1. Pillar 1 could be more complex than Pillar 1. So do you think that the guys that are in Latin America, they are studying what they are just not yet. They are waiting to see what they will approve. We are studying because our goal is to be ready to cooperate with the countries in order to implement. Because we don't discuss tax policy at SEAT. We don't discuss if tax Pillar 1 or Pillar 2 or Pillar 3. We help the countries to implement. But we cannot find ways to simplify. We are always turning things more complex, more difficult. Of course, for you, it's an opportunity, like I said. And I think you guys do a fantastic work because the companies, they need you, but the governments maybe need more because they don't have the conditions to evaluate and to analyze this kind of inform. So this is my question. Why we don't use more CUP, the arm's length price? Because you cannot compare things. You cannot compare Tylenol with Advil. But they do the same. No, but they are not the same product. Maybe you cannot compare the iPhone 14 with iPhone 13. So you cannot use independent price. You don't find similar product. So you go to cost and margins and prices and resales. And now we have more. We have the 6 method from Argentina. It's a simple method that works pretty well. If you analyze, like in terms of methodology, it's a very simple method, but it works. What is important? It's important to define things that works. This is what we need. We are facing a huge challenge in any tax administration. We need to collect more with less resource. Do you know how much costs to collect $100 in Latin America countries? $1.5. So the tax administration should be the priority for the government, but they are not. I don't know why. It's not my question, but they are not. So if we don't try to find safe harbors, try to simplify this, international taxation will be the same, an unfair game. Very good for tax consultant and for big economy. Because we can have inclusive. I said this to Pascal. Pascal, do you think that to have one vote is enough? No. We need to. We need to be prepared, and this is very, very difficult. Later, I can explain what we do at SEAT. But just to conclude, we will, for example, when we offer one training program on receive 10 students in a year. When we have every year we have a new group of students for our transfer price training program. We have 100 candidates. So because transfer price is a hot topic, of course, they are all trying to understand, to study, but looking for the private sector, to go to the private sector, if we don't create the conditions that we must have in the public sector at the tax administration. And OECD are doing a fantastic job. Of course, there are points that we cannot agree, but this is not what is important. They are trying to support the whole country. And this is crazy. So tax inspector in the world, you need an army to attend the demand. So we need to work together, the international and national and regional organizations, in order to collaborate, because what we have to do is to reduce the gap that exists. And I could give many examples of you, many. I think we will have time later, okay?
Yeah, we have. Thank you, Marcio Ferreira, Executive Secretary at SIAD. Thank you very much. So in this moment, we will have another 25 minutes to start a Q&A and any other comments, or at the end, an ending comments and remarks that you could have. Okay. So there is any question from the public? Yeah.
Hello. I had a question on the Pillar 1 discussion that we just had. You mentioned that this was more of a spillover effect from the BEPS regulation, which did not get approved back then. What makes us feel this is going to get approved now? And on what grounds? Like, what is the difference, and on what has changed from then and now?
I don't know, but no, I can confirm it is coming from the BEPS project from 2013, 2015. It was BEPS Action Item 1. So it was already identified that digitalization leads to maybe some profit shifting. Well, what I can just say is that even after BEPS, after 2015, that the countries have put in a lot of effort to find a solution. And yeah, I cannot predict the future if it's really coming or if it's not coming, but politically it has already been agreed. And maybe that's one comment which I want to make here is the complexity. I absolutely agree.
You know, the average of implementation of the 15 actions on BEPS in the world is 40%. And this is good. It's not, because I said in 2013, BEPS is a great
sorry, Gabriela, could you?
But it's a challenge.
Yeah, thank you.
BEPS is a process. It's not an event. It's a process. I said it's going to take 20 years. So after 10 years, in average, we have 40% of the measures implemented in the country. And it's okay, because it's a long road. And I think Pillar 1 is very important. But I don't, in my opinion, it's not a question to be implemented in 2022 or 23. What we need is to work and to define a good methodology that could be implemented by all countries of the world, not only for developed and rich countries. That's the point. Pillar 2 is fantastic. I think there is a risk on Pillar 2 that in the future, maybe the tax rate for income tax for the companies will be 15. As 15 is the minimum, maybe 16 will be too much. There is a risk that, but maybe could be good. Could be 15 in all countries of the world. Because if the 15 is the minimum, if you are taxing 15, the neighbor country will have problem to tax in 21 or 25 or 30. So there is a risk that 15 becomes the minimum and the maximum, no? But maybe could be good,
Maybe, yeah.
Well, I just want to say two more things about the complexity. So I totally agree that it's getting very complex and that the developing countries are really struggling to follow and to implement. And that's not a good thing. But on the other hand, you have to think about pillar one is already not the transfer pricing we know. It is a formulaic apportionment, right? It is taking 25% over 10% and allocating it. So I just wanted that we have that in mind, that the trend is already going to the formulation apportionment, but still if you have the formulary, it can be very complex. And what I've seen from the negotiations, and it's super difficult because there are 140 different countries, and what's coming out from the OECD G20 inclusive framework is always consensus. So therefore, whatever comes out is a consensus between all of these countries. It's definitely not ideal if you look from it from a technical perspective. It's too complex and you can criticize it, but I think that's what Pascal always said. It's like, oh yeah, that's the multilateral reality. Right? If you have so many countries sitting at a table, then it's getting complex. And I think the alternative is that the countries are not talking to each other and not trying to coordinate it, but then every country does its own digital service tax, which is also very complex. Huh?
Maybe we will get to, but maybe to add to that, that's actually a good link on one of the questions that I asked Abraham to ask me later on. That it was where do we stand on the pillars? So I can just reply to that now, because I think that's a good link to it. So. What we can say, or what I can add to what has already been said, is that from the OECD perspective and from the members of the inclusive framework perspective, we are still working full speed on this. Actually, as we speak, we are having a meeting now of the steering group with the delegates. So last week we had more meetings. So we are very much working on this, and delegates are approaching this with good spirits and wanting to come to some solution for because first, as Norman said, first of all, at the political level, it has been agreed. Also, I think what is very different from the 2015 and now is that in 2015 we had different options on how we would address the digital economy. So if you recall, there was an option even of a PE approach. Now we don't have those different options. Now we have the compromised approach to facilitate consensus. That was the pillars approach. So in that sense, it's very different, because now we actually have a framework that has already been agreed, and we are working on the meat to that framework. And of course, that's very complex. But it's already much more advanced than what it was in 2015. So we are still on track to deliver by July 2023, as Norman also mentioned. Another thing that I would like to emphasize, it's as Norman mentioned, you have amount A. Amount A, it's a new taxing right. It's not based on the arm's length principle. It is based on a formulaic approach. Whether this is simpler or more complex than the arm's length principle, there are pros and cons, and the whole different discussions on formulary apportionment versus arm's length principle. But it is it's different from the arm's length principle. It will coexist with the existing transfer pricing system, and it will maybe not affect your clients anytime soon, because we will indeed start with a very high threshold. And as Norma mentioned as well, perhaps with time, I can't predict the future, but perhaps with time, then that threshold would eventually be lowered if things are working in practice. But one point I wanted to make is that maybe it will reflect your clients' amount B. because amount B scope does not depend on amount A scope, so we don't have a threshold for amount B. Amount B will apply within the arm's length principle. So that's a big difference. So amount B, although it's part of the package of the pillars, it's not really part of digital. It is another motivation. It's motivated by the simplification of the arm's length principle. In the October statement, inclusive framework statement, that was when the pillars was politically agreed. There was a call that amount B should be, well, first of all, within the arm's length principle. It should provide simplification and it should attend the needs of low capacity jurisdictions. So we do recognize there is a lot of complexity in the system and the need to facilitate to low capacity jurisdictions. So that's our main focus. So as we stand now, at this point, amount A is still pretty much alive, but amount B is our core. It's what is consuming more of our work time at the moment. And it's also what we are seeing a lot of interest. First of all, because it will affect more companies since there is no threshold. It's just based on the baseline marketing distribution activities. And second, because, stakeholders have the view that amount B will have a higher impact on reducing disputes and potentially simplifying the system. That's what we all hope, and that we all recognize that there is this need. So
Well, I think one point that is important for developing countries, if you look from Mexico, excluding Mexico and excluding Brazil and maybe Argentina, for the other countries, maybe they can collect much more than the part that they will receive from A or B, implementing the VAT on the service supplied by the companies without a permanent establishment. And this is easy, and we don't need any international standard. In Uruguay, they are collecting VAT, in Chile, and I think in Colombia, but what they are doing is good, but there are better ways. In Chile, they are doing in a different way. But in Uruguay, for example, when you pay for Netflix or Spotify, if you use your credit card, they do a withholding on the VAT. It works, but if you pay with PayPal, they cannot do this. So it's complicated. But I think a priority for a developing country is to implement the VAT. It's our main tax. 25 to 27% of all tax collected is from VAT. So we can start collecting VAT. My friend from Panama, when I live in Panama, when I pay Cable Onda, now it's Tigo, I pay the ITBMS. When I pay my Netflix, first, I don't know. I just know that I receive a debt on my credit card. So I don't know in what country my payment is going on. But I don't pay the IVA, the VAT. So this is not fair. So if you have a hotel, you have to pay tax. But if you have 10 apartments on Airbnb, you don't pay tax. So we can collect the tax. And we have a very interesting solution. It's an open software. Any country, and it's implemented. Actually, it's ready to start using in Panama, in Bolivia, in Honduras, in Guatemala, Dominican Republic. And why they are not collecting VAT on this service? Because we need to approve the legislation. And do you know what the politicians said? No, this is a new tax. It's not a new tax. It's the same VAT that the citizens are paying for their local companies, but they are not paying for an English teacher giving class from another country. So I think it's very important to start collecting VAT on the digital service. It may, in my opinion, will be more important than the amount they will receive from Pillar 1. Pillar 2, no, Pillar 2 is different. I like Pillar 1 too, but it's complex, and the amount that a country will receive will be just a symbolic one.
Thank you very much for this very enthusiastic statement and plaidoyer for closing the knowledge gap. I'm in Texas since 27 years now, and working for Big Four, for huge German multinational, or for a medium-sized company, and for a medium-sized tech service company. And what I saw is totally that what you described. That doesn't count only for the development states and development countries. It's also for the industry countries. Who in the room can really give assurance to his client in terms of transfer pricing? If you give a statement, I suppose nobody will give this. Nobody. It's no exact science, okay, the preface of the OECD guidelines. But what is interesting for me, and that includes the other presenters here in this, at this stage, is I found it very interesting that the UN manual on transfer pricing is much more concrete than the OECD guidelines are. Yeah. First of all, why isn't it so difficult to give not only vague statements, in terms, for example, action point 8 to 10, or what we discussed this morning, transactional profit split method, Nobody really knows how to apply it, and has assurance, really assurance, which advice he should give his client. I've implemented 3 or 4 attempts, to have a profit split in place, but couldn't give any firm advice on this. With typically big letter accompanying my advice. So why isn't the OECD be capable to do what the UN does to a certain extent? In practical means. And secondly, just a remark, that's my impression. For the first time, which refers to the Pillar 1 initiative, I got the impression it's a more or less pure ivory tower discussion and development taking place. Even we have a trickle-down effect further on. And nowadays, I think most of the people here in this room are not affected, not really interested and informed about it. It's a Big Four marketplace. And discussed with the OECD, Mr. Wingen or Armand or whatever, or with the Big Four partners. How could we get the impression that you are now more close to the market, to the needs, or also to the medium-sized companies we predominantly serve here in the market, and how we can any support from you to give a better advice to our clients?
Thank you for the questions. The first question, I think it's funny for me to address because I was working at the UN and now I work at the OECD. And so maybe I think first of all, I agree with you. It's true that the UN manual has a lot more concrete examples. But I think from mainly because, first of all, because the structure of the organizations are different, right? So in the UN, you don't have country delegates. They are not speaking on behalf of their countries. They are speaking on their own personal capacity. So that's very different because you don't need a consensus that Norma mentioned. Everything the OECD is a consensus. That can be good and bad. It's good because once you reach that consensus and when it's out there, the countries, it's accountable, right? Because, even though it's not legally accountable, it's not legally binding. However, they did have a delegate, a person that was acting on behalf of the country, agreeing with that statement. But it's also bad because when you are trying to reach consensus and then the transfer pricing guidelines, it's a bit funny that way because you have a part of the guidelines that it's a consensus of our OECD members. And then you have another part of the guidelines that was updated after BEPS that it's an inclusive framework. So you have many more countries that was, that were discussing on that part, that were giving their inputs to that part. That also means it's also a consensus, but it means that because it's a consensus, a lot of times we can lose some practical points, and we can lose the ability to give, stronger statements and more practical advice, unfortunately. So I think the main difference is this, that in the structure of the organizations. And another difference is that the UN manual is actually written, it's approved by the UN committee, but that again, they are not working on the capacity of their countries, but it's also written by the subcommittee, and the subcommittee is practitioners. So then naturally you have more practical guidance there.
Sorry for that. More or less formal reasons.
Yeah.
I understand totally
Yeah.
the government you are in and the government environment. Yeah. But from a practical standpoint, I'm totally with you. Yeah. In closing the gap and making it workable and administrable. Yeah?
Yeah.
It should be also an interest of the OECD. Yeah, for the inclusive framework, yeah, to make it doable and practically auditable, yeah, and give also to the people and the business people a certain degree of tax certainty, yeah. So therefore, it's just my impression. I'm totally aware I'm not the only one, yeah, but it's behind me, yeah. In every single case I'm advising, yeah, I can't even translate it correctly, yeah, even to business people, to economists, yeah, and controlling people, what is really meant and what's the reasoning behind, yeah, and how we can concrete manage and conduct what we are forced to do, yeah. And just to have a feedback again.
No, that's perfectly valid. Just maybe one thing that we are trying to do more often lately, it's the platform on collaboration on tax guidances. That's a joint work between the OECD, the UN, the World Bank, and I feel like I'm missing. I'm so sorry. The like IMF. I'm so sorry. So those guidance are there. We have one on comparability, another one on documentation. It's not perfect. We should expand that to more areas, but that aims to give more practical advice as well. But point taken. And maybe on your second point on the pillars, it's true, but maybe that I would just mention again the amount B, because amount B will affect everyone, because it's not based on threshold. So that will also affect, if you have a small, medium enterprise that have a cross-border baseline market and distribution activity.
No, my final comment is during many years I worked with tax policy. I was director of tax policy in Brazil 20 years ago. I think we always should consider the tax transaction cost. For me, this concept is the most important in any measure. So when you implement a new policy, what the impact on the tax transaction cost? Tax transaction cost, I think you all know, but for me, is like a coin, two sides. One is the the cost of compliance.
Sorry.
The cost of compliance is one side. The other is the cost to management, the new measure. No, so it's always, this is very important, because in many cases you increase the one side more than other. If you collect more than the cost, it's good, but you should see the impact on the companies and the impact in the government in terms of to management, the new policy. This is why I think, for example, collect VAT on the digital economy is a good measure, because it's not a problem for the tax administration, because we collect VAT in all companies. And yes, it's not a problem too for actually it's better than a problem. We'll reduce the situation that we have now that is unfair with the companies from the country, because the companies from abroad, they don't pay VAT. VAT on the digital service, for me, should be a priority in the countries while we approve Pillar 1, Pillar 2. Well, Pillar 2 is different because we always talk about the 2 pillars and they have nothing with each other.
Thank you. There is any other participant that would like to ask a question or any other special remark? Thank you very much. It was an amazing panel. Right now, let's give a cheer for our panelists. Thank you so much. At this moment, yeah, of course. Yeah, go ahead. Please, yes.
Which country received the first internet tax return in this world? Which country received in what? You know? Oh, Ana, you know everything. It was in Brazil in 1996. So, yes, well, the first digital, the first tax return by a diskette was in Latin America too. So, if you go to Ecuador or Chile, and soon in many other countries, in Ecuador, you receive a draft VAT tax return. In Chile, 98% of the taxpayers, I'm talking about VAT taxpayers, they receive a draft tax return, and 96% just say, okay. So this is, in Latin America, in Caribbean, we are, in my opinion, ahead of many developed countries in the use of IT, because it was the only way that we found to solve our problems. So in Brazil, you know the SPED, the system called it SPED. You don't return anymore. The Brazilian tax administration pick up all your data from the accountability and generate the tax return. So for developing countries, I think we need to invest in professionals, in careers, and in the technology. This is the way I think we should invest heavy. And we are trying to do this in ATAF or with ATAF. They are doing a great job in Africa and all around the world. Technology will reduce our problems a lot. Thank you.
Thanks to you. Thanks to you. And let's give it a cheer. Thank you so much. Amazing. So right now we will have a coffee break again, and then we will have the last panel session of the day. That is, the topic will be about tax strategies for high income earners companies, lessons and challenge in North America audits. So see you next. Thank you so much. Let me check. ¿En cuánto tiempo es el próximo panel? Okay, we will have a coffee break of 20 minutes and then we'll go back. Thank you.
Thank you so much. Very interested in Czech tax system. You should mention that you do have some clients that have some Czech tax system. I have to keep doing as a role model. But maybe it will be okay.
Ya yo. Vamos a quitar esto. ¿Te lo pongo? ¿Cómo te lo pongo? Ahí está bien. Listo. Perfecto. En este móvil me sale de este recuadro o sale todo. Solo recuadro.
Muchas gracias. Chequeala. Nada.
It's like that is on top of it. So it's like 100. Well, there's 140, I guess. They have a very yeah.
I need more water. Okay.
A lot of the multinationals are located in Canada. They're generating a lot of development work in Canada. And one of the first cases I worked on when I arrived at the Canada Revenue Agency was specifically an audit where they were looking at the development work being done, proxying that with comparables for third-party development work, and generating a royalty and doing a reassessment based on the royalty amount that should be going back. So again, here we're talking about, this is similar to the first point I raised. It's about clearly defining the parameters in which the subsidiary is working. And now with DEMPI rules, could you view this as non-routine? Can you actually be doing development work in a subsidiary country and then being able to say that it stays routine. So ultimately, the CRA has audited sizable development entities looking to attribute profit sharing to develop products. So the objective here is to clearly define, again, the roles and responsibilities, who takes the investment risk linked to the development, and characterize the entities to determine who is investing in the development, who is taking the risk, and then finally, who is providing guidance and ultimate approval of projects. One of the examples, we were doing a site visit with this video game developer, and we said, yeah, but we've done everything with regards to the milestones as to where the game is at, what strategy of play, etc. All this work is being done in Canada. What is being done in the US? They turned around and said, well, we paid all the salaries, we determined the general concept of the game, and in this particular instance, we didn't like the game, we scrapped it. It was all gone. Everyone was paid their salary, and that's the characterization that we put forward. So it was, in that case, it's really about defining roles and responsibilities. And that's it. So those are the four that we were proposing. It's not high income, but it's about proper attribution of income based on what the company wants to do.
Thank you so much. That was Andrew Bergeron, partner at Golin, WLG. Right now, we will continue with Augusto Camarero, partner at TP International Advisors.
Okay, thank you. Well, thank you everybody to be here today, and PPI for the invitation to present this. Sorry. Where is the box there? Okay, she put it. Okay. Well, and thank you PPI for the invitation to present this today. Yes. Let me see if she's putting there. Okay. Well, first of all, I wanted to show you which are the main industries in US, or which were the main industries in US in the last 4 years, 18 to 22, and based on that, there is a company named Ibis, which based on 1,000 companies' profits, develop an analysis and a model to check which are the most profitable companies in US. Yes, we used to study this when we started a business in US 3 years ago to make a strategy to address and see where are our future clients. We started working for companies that are in the business of investment vehicles, the retail vehicles, a big group, and also in the commerce, e-commerce companies that are marketing ads on the internet, and several of these companies, which are the biggest companies in US. There is a full list of around 10 different industries, and I guess that this will be the focus of our presentation today. We base like a model based on recommendations on our experience of having worked for them and realized many challenges that appear when we were engaged. We were engaged to help them to accommodate things in the US, in Latin America, because they grew really fast. They raised capital in the rounds, and they got to be unicorn from one day to another, and being Argentine partners and converted to an American holding was really a challenge for them. People didn't know even what is transfer pricing, so we had to explain them when to comply rules. And well, as you know, the IRS is really tough and difficult, and penalties are applied. And with the Latin American ideology, it's difficult to convince people to comply with the rules. So when you talk to a partner, an IT developer, which is really a crack, as I say, they do not understand why they have to pay taxes in US and in every country and defend they defend the money, their pocket, and they don't know that there are rules that had to be complied. So we went through an 8 points, which I will develop now, regarding our strategy to comply with the rules in every country. The groups are really big, of around 17 or 13 countries, so the idea is to comply with all of them, and we have to study all the legislations to comply with the transfer pricing rules. So in general, these points are common points, regular points that you will know when you apply maybe a work for 2 or 3 countries. But we make like a big transfer pricing study for 10 or 13 countries at the same time. So we run a full interview with the different directors to see which are all the intercompany transactions. People in general, when the group is growing fast, they doesn't know do not know, which is the number of entities that are having intercompany transactions. They run business, they operate intercompany, and then after the transaction took place, call you and tell you, well, we have render services from our intercompany, and we do them start advising on a benchmarking after the transaction took place. So this is a challenge, and now that they are a subsidiary of a US company, could bring them a headache at the end of the year when they have to comply with transfer pricing rules. Later I will speak why. So once we have the total transaction of the company, total transaction, we go to the an analysis of different rules. We analyze functions, risks, assets, and the value change of the company. We try to study where are located the main resources of the company and what they need, where they need money, where they need that the money be ready to be used, for example, in countries like Argentina or Chile, where they have, or Uruguay, where they have a lot of people working on developing. So they need the money to pay salaries, and the foreign exchange control regulation rules of Uruguay, Argentina are really difficult, tough, and we have to think with them the best way to leave the money to pay the salaries to them and quickly to run their business. So when you go and see all the picture of the group, yes, we find inconsistencies, many of them, because they have operated around 1 or 2 years and they do not have profits recognized in many countries. In general, they start business and recognize the profits in the country that they work at the first year, and then we have to translate the profits to the real country that is keeping the substance. So this is important, and they try to move the money directly to the tax haven, and we'll have to fix that. We have to work with them in order to put the corresponding markup to the transaction that was developed in the country that people is working actually. But the issue is that today everybody works from their home. Everybody works maybe moving from one place to another, and they doesn't want to recognize the corresponding markup for those countries. So at the end of the day, when they prepare the consolidated financial statement, we see that countries like US are not showing any profit, and maybe they have 10 or 20 people working in US, or maybe they sell their services in US and they have people supporting the applications, and they do not have any markup in US. So this is really an issue for them. So at the end of the day, we find that there are a lack of recognition of the intellectual property. Sometimes they create new applications, and we have to see the costs that they incur to create the evaluation of that intangible, and we had to assure that the country in which was created received the corresponding money for that. So when we prepare this analysis, we have to consider many other issues. We also have to see tax issues, such as value-added taxes applicable, as Marcio said before. This is an important thing because certain taxes have withholdings. So in that cases, if we work with a company that has tax issues with certain countries, we have to contact the corresponding tax person to be advised at local level. The idea is that we be supported by the corresponding people in the tax jurisdiction that the client operates. We can help in general in certain countries, but there are countries in which you need to contact a specialist to avoid being challenged by the authority. Then we study the current income tax rate, yes, the nominal rate and the effective rate in each country in order to see how is the level of payment of income tax that the group is paying in each country. The truth is that when you run that analysis, you find that the countries that has a lowest rate are the countries in which this fast-growing group get the most profitable and part of the business, and besides, they try to move all payments to that countries. So what we do is, try to convince the managers and the partners of the group to see that there is a penalty or there is a possible tax audit in front of them if they do not have like a standard rate assured, like the 15% or to pay a minimal level of rate as they should in the corresponding country. Then we have to see and be careful with the exchange rates and the foreign exchange control rules. In general, people try to transfer money without seeing that there are penalties or there are compliance rules in each country. So what we do is to help them with the filings of certain foreign exchange control information regime. We have to assure that they comply with the regulations that are issued by the central bank of each country. And in general, there are countries with very complex rules, such as Argentina, Chile, in which they have to file returns on a quarterly basis or on a monthly basis. Then we recommend to study the economic, political, and legal stability of each country of America, because in order to accommodate the situation, we have to let them know that if they had to do things well, they should move people to certain countries, and that will be a direct impact on their business. Of course, that these changes cannot be made from one day to another, but the truth is that the substance really should follow the real economic of the business. And in that sense, we have to study the political situation, the economic situation of the country, and recommend them to move people to the corresponding country in which the money is generated. We see that the groups start in Latin America, and after 1 year or 2 years, they try to go to US and explode the business, they're selling the application or games, for example, and then they don't have people in US working at all. So the money is collected in US, the money is subject to the income tax return in US, and there's nobody in US. So this will be challenged by the authorities of Latin America. Yes, they do not have sustenance, and this will be a problem at the time of emergence of acquisition. Later, the people, the developers want to sell their business, and of course, in a M&A process, the buyer will make a due diligence process and will try to challenge and determine all the taxes that the company did not pay. And if that is the case, the value of the company will go down considerably. So after that, we have to take into account custom rules. There are groups of companies that sell goods, and there are difficulties in customs. We see that many groups sell products at a lower value and then try to increase rapidly the amount of the abroad. And the truth is that you cannot move or change the value of a good in custom from one day to another, plus more than or plus 10 or 15%. If you increase the values of customs goods, the custom authority will challenge that you have paid really low in the past. Yes, when you advise a company that is selling goods or importing goods, you have to be careful to run a benchmarking analysis ex ante to assure that the value of the goods will not increase considerably from one time to another. Yes, any change that is higher than 10% within 1 year, I mean within the same year, will be, of course, subject to scrutiny by the authority. So in that case, the recommendation is to make a benchmarking analysis on the manufacturing or on the distributor in order to assure that they collect the corresponding money. Then there are other taxes applicable, like gross receipt tax, which is a cost for the group, or value-added tax. There are certain reimbursement of expenses within the group. Certain countries which has a very low exchange rate, like Argentina, maybe Uruguay, against the dollar, are the countries in which all things of the group are paid. Everybody wants to pay in Argentina because it's really cheap. The exchange rate, the actual exchange rate is just 400 to 1. And this is very tentative to go through Argentina, pay everything there, and then recover, yes, the money by the government at a very low value. Instead, if the group hired the suppliers abroad, for example, in Chile, Paraguay, Uruguay, etc., the cost of hiring, for example, Amazon servers or paying marketing campaigns, etc., will be really high. So the idea of that is that if the group has reimbursement of expenses, yes, they recover all the expenses paid on behalf of another subsidiary. And then if they have to start running business in each country of Latin America in which they do not have presence, we have to take care about the bureaucracy of run business in such country. It's not the same to open an LLC in US, in which you can open an LLC in maybe a week and have all things ready to operate, than in Argentina or maybe Chile, in which you need to open an account, which can be a nightmare of 3 months. Yes, to open a company maybe took you 1 month, and if you see Uruguay or another country, it's much easier and quick. You have to demonstrate that you are making business legally, and the bank will require a lot of things. So what we do? We propose an action plan with all the alternatives to the case, and after thinking about the necessities of the shareholders, we try thinking about relocation of human resources, key human resources. We think about the creation of new hubs in countries in which things are really cheaper, like Argentina, like maybe Uruguay, well, maybe Brazil in future if rules change in terms of transfer pricing. Then we think about centralization or decentralization of certain functions, or just outsource certain activities of one company in which the human resources are specialized. Well, another thing, as I mentioned before, is to assure the IP creation in the country in which it was created. And well, when the action plan is designed, the idea is to sit, to have a meeting with the client to discuss how we are going to implement the recommendations. And in that case, we have to try to go and each country speak with the general manager of the country, the legal representative, and implement the plan as it was agreed with the controller. As you know, the local manager doesn't want to make changes to their business because it's really tough, but this is something that we usually help to the owners of the business. Then, once everything is clear, we develop a transfer pricing policy in writing in order it is complied every year. And well, we review the transfer pricing agreements prepared by lawyers firms, yes, that in order that they say everything that was planned in the transfer pricing policy. So the conclusions of this work is to know in depth the business of the client, yes, to try to have interviews with the main people, because you will discover that the company is running business behind your back. You will, as Anna said today, when you go to the interview, you will really always know much more than the company, and you, based on your knowledge, you will be recommending the people changes to improve their compliance in any country and paying taxes as corresponds. Then the idea is to summarize the findings and the main factors that drive recommendations in the action plan. Yes, this will be the base of your work. Yes, the changes are not invented just to sell services. The idea is that the company get the objectives that they are planned from the beginning. So every change has to be supported by a reason, which must be included in the action plan and in the transfer pricing policy. We should consider include certain outsourcing work with the client in other areas, as I said, taxes, foreign exchange control regulations, and try to work together with other specialists. Yes, the idea is to share work. We are here to share work. So the idea is when some certain tax or regulation is out of your scope, the idea is to hire the specialist in the country that is working your client and work together to help your client. Then, in order to sell any change proposed, you have to evaluate the cost-benefit analysis of the recommendation, formalize, well, as I said, the new policy in writing, and then review the correct implementation of the policy, which maybe take you a year or 2 years, depending on the size of the group. And well, once everything is done, you have to assure that the corresponding people that take the decisions be aware about the importance of running benchmarking analysis on a new transaction. Once everything is in order, you have to assure that people will ask the tax department to be advised on transfer pricing issues before running the transaction. So this is the whole picture and the conclusions of this recommendation to your work, to everyday work. Yeah.
Amazing. Thank you very much. Augusto Camarero, partner at Transfer Pricing International Advisors. And we will go with Pratik Manani. He's the manager of KNAB. So you have the floor.
Sure. Thank you very much. Can we have the presentation, please?
There you go.
Okay. So in past 6 months, there are a lot of developments that are happening on Pillar 1, Pillar 2. Recently, US also passed Inflation Reduction Act. So under that act, one of the one of the important aspect that they have introduced is a corporate alternate minimum tax. So basically, all the large corporations having adjusted financial net income greater than 1 billion. Okay, so they will be subject to corporate alternate minimum tax. So they will have to pay a minimum tax of 15% in USA. Now, if it's a subsidiary of a foreign parent, so if it's a US subsidiary and a foreign parent, in that case, the threshold would remain same, but over and above that, a threshold of 1 billion, okay, that local subsidiary needs to have, AFSY greater than 100 million in USA. Now, again, there are a lot of questions around, how this will, sync with global minimum tax. And again, there is no clarity, but there are various, differences between global minimum tax and the corporate AMT that US has recently introduced. So yeah, we might expect certain guidance, from IRS on that. I mean, what will be the future look like? Whether there will be any relationship between corporate AMT and global minimum tax. Now, secondly, IRS is investing, heavily on their enforcement. So they recently, allocated additional funding of $80 billion. Okay, to be utilized over a period of 10 years. Now, this 80 billion is going to be utilized for modernization of the systems, enforcement, operational support, and taxpayer services. And it is estimated that, from, out of this 80 billion, approximately 40 billion is to be used for enforcement. So we can expect a lot of scrutiny and aggressive stand from IRS on this. In fact, they started, hiring IRS officers, very aggressively. So yeah, large corporations needs to be aware of this fact. Okay, now third point on economic substance. So in US, there is a regulation. So the economic substance doctrines are a part of US regulations, and recently what we have seen is various IRS authorities have communicated this in various webinars or conferences. That if any related party transaction that fails economic substance doctrine, so there might be penalty. Those taxpayers might subject to a transfer pricing penalty, which may range from 20% to 40%. So what exactly this economic substance doctrine is? So basically, if any transaction, so it will qualify as the transaction would be qualified as having economic substance if any transaction has meaningful impact other than any federal income tax effect, and if it transaction has a substantial purpose for entering into a transaction. So the whole purpose of this regulation is many times we have seen that taxpayers structure their business such a way that to avoid the federal income taxes. So to avoid that, this is a part of US regulations. And again, over and above this, one of the IRS officer have communicated that they are also planning to levy penalty for incomplete documentation. So we have seen that a lot of taxpayer prepared TP documentation, but again it does not contain sufficient information for IRS to determine the transactions, give sufficient information about the facts of the transaction, the group overview. So yeah, those taxpayers might also be subject to transfer pricing penalties. Okay, and last couple of years, IRS has won a few cases against the taxpayers when it comes to transfer pricing. So we are going to discuss, this case laws. So I will not, discuss this case laws in detail due to paucity of time. But maybe I can just give you overview and what are the key takeaways, and I will try to make it more interactive as possible. Okay, so there's a case of Coca-Cola versus Commissioner. So this is a classic case of contract manufacturer. So historically, the position of IRS was that if foreign entity is doing contract manufacturing, okay, so that foreign entity needs to be compensated on a cost plus basis rather than profit split method. So about Coca-Cola, so again, US parent entity having foreign subsidiaries. So US entity has given licenses to foreign subsidiaries called supply points. So supply points manufacture the concentrates that are used for manufacturing of their product. Now the supply points will sell this product to third-party bottlers, and third-party bottlers will again sell this goods to third-party customers globally. Now here, the taxpayer applied profit split method under formulary apportionment. So in 1996, there was a settling agreement between IRS and the taxpayer. So the taxpayer for the year, they applied this formulary apportionment method, but the point of the argument of IRS was that the supply points were essentially a routine manufacturers. They don't add any value. They don't have any kind of intangibles. So they should be compensated on a cost plus basis using comparable profits method or a TNMM. So IRS selected supply points as a tested party and reallocated all the residual profits to US entity. So essentially, those supply points are being compensated on a cost plus basis. In this case, so the taxpayer, proposed alternate method using a cut method. So here, the stand of the taxpayer was that they have a similar agreement with third party, wherein they are paying royalty to a U.S. entity. But again, IRS also rejected that claim, saying that the economic circumstances under which that agreement was entered was not comparable. That's why they rejected this method. And finally, IRS selected CPM as the best method. Now, a second case of Medtronics, again, US entity is a parent entity. They are having foreign subsidiary. So basically, this subsidiary manufactures highly specialized medical products. And so US entity entered into various licensing agreement with this subsidiary, wherein it provided license to a subsidiary for manufacturing and sale of the product. And under this agreement, they were charging two different royalty. So 29% for manufacturing of the devices, and 15% for manufacturing of leads. Now, under this agreement, okay, so if there is any product liability risk, so that risk needs to be borne by the subsidiary itself. So US entity will not bear that risk. So if there is any product recall, if there is any claim filed by the customers, so the manufacturer will bear that risk, and it will not be passed on to US entity. So in this case, what IRS did is they increased the royalty to 44% for devices and 26% for leads. Again, so this was there was a MOU between IRS and the taxpayer in 2002. Now in 2005 and 6, the IRS considered the subsidiary as a routine contract manufacturer and selected CPM as the best method. Again, the costless approach of IRS. So this translated, the royalty rate of approximately 50% in 2005 and 59% in 2006. Now, what text quote rule that? So again, it's a CPM versus cut. So whether CPM is the best method or the cut is the best method. So again, the text quote rejected IRS CPM because it does not, pass on, because the product liability risk was borne by the subsidiary. So the subsidiary was not enough compensated if you use CPM method. Now, again, the taxpayer also, suggested alternate method of using cut method, but the comparable company that they selected, okay, they were, they were failed to meet the comparability criteria. So again, here the IRS is more concerned about, they go in detail and exploring, whether the comparability criteria is meeting or not. And finally, since IRS rejected, tax court rejected both CPM and cut, they proposed both IRS and taxpayer to, suggest alternate method. So IRS stand was clear that it's a CPM should be the most appropriate method, whereas the taxpayer come up with a solution. Okay, that's an unspecified method. So it's a three-step approach that they follow. So in the step one, they applied, modified version of cut method. So basically, in the first step, they allocated a certain percentage of royalty to US entity for use of this trademark licenses. So this was the first phase where US entity is being compensated as a certain percentage of royalty. Now in second phase, second step, the manufacturing entities. So since they are manufacturing products, so there will be certain routine percentage for routine margin for performing this manufacturing activities, and whatever residual profit that they have, that profit should be split between US entity and the taxpayer or the subsidiary between this ratio. So it's either 65:35 or 50:50. So what tax court did, so they did accept the taxpayers' suggestions, but instead of 65:35 or 50:50, the tax code said that 20% should be allocated to the subsidiary and only 80% should be allocated. Sorry, 80% should be allocated to US, because US is the owner of IP. So here, why I covered Coca-Cola and Medtronics, the key difference between both the cases is that in case of Coca-Cola, okay, they were not able to demonstrate whether, the subsidiary owns any intangible property or a technical know-how, whereas in case of Medtronics, so the product under, the consideration were highly specialized product, okay, the product went through, 300 quality checks. So again, so if any of the quality check they misses, okay, then there might be more significant implications on the product recall and product liability, and that entire risk is borne by the subsidiary. Now again, the very recent case in February, this case law came up. So again, US entity having subsidiary in Brazil. So all three case laws, there is some element of IP. Okay, so globally, this 3M as license agreement with related parties where they charge 6% of their third-party sales. In 2006, so Brazil entity, they used trademarks owned by the US entity and paid royalty to 3M US consolidated group. So there are two entities in US. So one is parent entity. So, and there is one more step down subsidiary of a US entity, again in US only. So parent entity is company P and the subsidiary in US is company S. So both this company P and company S, they provided certain the trademarks to the Brazilian entity. And while globally they were charging 6% to their other group entities, but in Brazil there is a restriction that you cannot pay more than 1% of royalty. So that's why they could not, the Brazilian entity could not pay 6%. So when this case come up with IRS, what they did is basically so basically, I mean, they refer to one of 482 regulations saying that whatever is the regulations in foreign jurisdictions, we are not concerned with that. What you need to see is whether you need to abide by section 482, and accordingly they made the adjustment by considering 6%. Okay. Finally, on the audit points. Okay. So I will quickly cover these points. So here I have one question for you all. So how many of you have seen, an intercompany agreement, which is, maybe a 2-pager agreement or very vaguely drafted agreement? Maybe any one of you? Almost everyone, right? Even I have seen, 2-pager agreement or even a 40-pager agreement, intercompany agreement. Yeah. So again, when you prepare intercompany agreement, what we need to make sure is, so there is a balance between what is needed and what is to be submitted to the tax authorities, because sometimes, what happens, while you might be doing a lot of things, but again, what you need to see is whether you want to submit those information with the tax authority, and whether, whether you are actually doing those services or whether you are performing those functions. So yeah, it's when you draft intercompany agreements, you need to be very careful what information you're putting in the intercompany agreements. Now, second, on the robust documentation, again, so when you prepare a documentation, the functional analysis is the key, I would say heart of transfer pricing. So again, so what we generally do is, whenever we prepare a FAR analysis, we ask management to set up a call with each, department heads. We interview them, and based on that, we prepare a functional analysis. So when I say a robust documentation, so your functional analysis should cover all, the economic reality of the business, what exactly you are doing, whether you're, what is the roles and responsibility of entities involved in the transaction. Now again, self-assessment is really important. So even before the tax authorities, catch your neck, I think what you should do is you should step in the shoes of the tax authority and see, whether there are any high-risk area, or whether any transaction that you see that might impact your business or the tax liability, and accordingly you should take proactive action on that. I will not discuss on the intangibles because in morning we have heard a lot of about intangibles. So I will skip that part. Again, on the limited distributors, whether LRD should incur losses, whether what should be the accurate margin for that, and if they are incurring losses, how to justify those losses. So again, the OECD had come up with the guidelines on the limited risk distributors during COVID. Those LRDs incurring losses. So again, what we need to see is so this losses, is it because of economic circumstances or is it because of the related party transactions? If it's not in your hand, it is because of external factors. Okay, you need to document that in your report. What made why you're making losses. So you need to document that in your transfer pricing documentation. Again, it's a very hot topic: recharacterization of debt into equity. So a lot of time, we have seen that if the borrower does not have capacity to, borrow the funds from market, so IRS may recharacterize your debt into equity. So here also intercompany agreement would play a really important role. So there are 14, characteristics that will define whether it's a debt or equity. So whether there is obligation to pay to repay the debt, whether you are paying interest on a timely basis. So there are 14, conditions that you need to fulfill. So you can, again, what you need to see is what is the credit rating of the borrower, whether they are able to borrow the funds from the open market. Okay, so prior ruling or agreement may not have a persuasive value. Okay, so again, if you have received a positive order from IRS or any tax authority, that does not mean you are secured or you will not face any litigation in future, because principle of res judicata is, not applicable in all the cases. So you need to constantly updating your transfer pricing policies. Periodic health check. Okay, so this is an interesting case. Okay, so we are doing health check for one of our clients. So it's a client is based out of India and having subsidiaries in USA. Now, India is a manufacturer of the pharmaceutical product and US is a distributor. So in this case, what is happening in US, we are showing the US entity as a limited risk distributor, but in India report. So India report is prepared by one of the big four. So they are showing, the US entity as an entrepreneur. So again, there has to be consistency, and you need to check, whether both the, the report that you are submitting to tax authorities in various jurisdictions, that should match with each other. And finally, use of technology for automation. So here the transfer pricing, operational transfer pricing would come into picture. So you need to, align all your internal systems and whatever tool that you are using to make sure that you are able to give real-time information to all the tax departments, to your internal, clients as well. So yeah, I think that's it from my side. Thank you very much.
Thank you very much, Pratik. Pratik Manani, manager at KNAB. So right now we will open a little Q&A session or any other comments that you may have. So the floor is open. There's any question that any of you would like to add or comment or final keystones?
Actually, I want to touch on one of the points that Pratik brought up, and that comes back to the case law for the Coca-Cola for Medtronic, and that's, on the one hand, for us, we're saying consistency is key, right? And then on the other hand, you've got examples where the IRS said, yeah, this works, and then the company continues to apply it, and then the IRS comes back and says, well, no, actually, we have second thoughts on that, and it's interesting because then if a company is making an effort, and in Canada we use the term reasonable efforts, that's what's in our Income Tax Act. Why are then the agencies coming back and saying, well, yeah, we know you've applied this approach, but it's not right anymore. And we just we just advised the client to pull out of the advanced pricing arrangement program. They had a renewal on an APA that they had between 2008, 2018. They basically came back to the pre-file with the CRA saying, we want to apply the same approach on this transaction. We want to pay the same royalty amount. We want to pay the same management services. We're not even talking about a cost plus. And then on another technology, they wanted to pay the same percentage, 5% with a cap. And then we were put through the ringer. Well, you didn't redo your economic analysis. You didn't do this. You didn't do that. He says, yeah, but we're applying the same approach moving forward. You want me to demonstrate a 1% royalty? I'll go back to my desk and I'll demonstrate a 1% royalty. You know that's possible. And what about the management services? We're not even proposing a cost plus. So ultimately, I think it's hard to advise clients from that perspective. This is, on the one hand, you want to be consistent because companies don't change overnight. But on the other hand, it seems like, well, if it makes sense to change the functions or the characterization so that you can bring more money back, it becomes difficult then to advise and to plan in that circumstance.
Thank you very much. Seeing none. Well, thank you for this incredible panel. We have ended the last session of the day, the first day of this annual Global Conference. I know you need to rest right now. We will have 2 hours in order to rest. We would like that we gather again at the lobby of this hotel at between 7 and 7:10 p.m. So we at 7:20, 7:30 p.m. can go to a private bus that we will have for all of our members, representatives of different organizations and companies. We'll have a special dinner. Please, ladies, we recommend that you don't use heels because we're going in a boat. So we will go to a Seine River and have an amazing night. So see you at 7. Thank you for this incredible day. It was really interesting, and I hope it's getting challenging for the next day. Thank you very much.
Can we take a picture of the 3 of us together?
That would be nice. Yeah.
Yeah.
Yes. To have the
In front of the
this one.
Clean background or maybe
We can find.
You want to take a picture? No.
Thank you very much.
Okay. Enorme. Ah, claro, que no tuvieron ese tipo de interacción. Exacto.
Sí, seguro puedes pedir el video. Sí,
Ah,
sí.
sí.
No, ¿verdad? Ellos después
¿Qué?
pueden pedir el video.
Creo que
Sí, se graba, entonces
no
está
se grabó
grabando.
la ponencia completa, pero creo que sí podemos pedir algunos cortes. y
Graban
fotos.
ciertas secciones, sí,
Exacto,
sí, sí.
claro. Las fotos, cuando nos las envíen, se las hacemos llegar igual también. Bueno.
¿Las fotos de lo que sacó el señor hoy?
Sí, las de la cámara. Sí.